We're just observing, obviously, a pretty frothy set of markets right now.
It is about tech, and I think it's something to keep an eye on.
I do think there's a statement of pause here, right? We have to see these earnings come through.
I think we could get a little bit of rockiness.
I think the rally can stay for at least through the summer.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, we have a deal.
We've reached a deal. I think you were saying this is probably the biggest deal ever reached in any capacity.
We have a deal, and it's a big deal. It's a huge deal. It's 15% tariffs across the board, all inclusive.
I think it's the biggest deal ever made. Thank you very much. Congratulations.
The United States and the European Union striking a trade deal, heading into a huge week, packed with the latest economic data, plus earnings from some of the biggest companies on the planet. Big tech results just around the corner.
A lot to digest. We have to focus in on what we're getting this week, which is Apple, Amazon, Microsoft, Meta, all reporting this week. If you look just the 162 companies that are reporting this week from the S&P 500, you understand what a busy week this is. Julian Emanuel, though, pointed out to the fact that we're getting trade deals, we're getting the tech earnings, we're getting Fed data, we're getting the Fed meeting, we're also getting jobs data that comes on Friday. As he said, it makes it truly a moment of truth for markets.
Let's unpack some of this and start with the deal over the weekend, a 15% tariff. And just notice the difference between the Europeans and the White House. The Europeans are celebrating stability. The White House is celebrating asymmetry. There is a big difference between the two.
It is a messaging instrument, and if you want to have the judge take a look at the euro versus the dollar this morning, and you can see the euro is weakening versus the dollar. So if the market is deciding, they are saying that the U.S. maybe got the better deal when they're talking about asymmetry, and they're talking about how the U.S. is demanding a tariff rate that went from 2.5% to 15%. And Europe is celebrating.
The economic story is yet to be written. Let's be clear about that. But over the weekend, that's a major win for the President of the United States, and we move on. Maybe delay things again with the Chinese for another 90 days. We move on to a Federal Reserve decision this week and economic data with payrolls on Friday.
And really, when you tie that together, we haven't really seen the full ramifications of any of these tariffs. And that really becomes the ultimate existential question for when it comes to the economic data as well as for the Federal Reserve. How much will we see inflation come through? Are we going to see more of a hit for earnings? And one thing Lori Calvasina of RBC Capital came out with was that we haven't heard a lot of guidance for 2026. So everyone is trading as though 2026 is really what you have to focus on, and then gives no guidance as to what it's going to look like. Try to square that circle, and that's sort of where we are.
We're not flying blind anymore. All-time highs in this equity market. We add some weight to it. Equity futures positive by 0.25%. Coming up this hour, we'll catch up with Steve Chiavarone as stocks look for a sixth straight day of gains. Kate Kalutkiewicz, the former Trump White House trade official, as the US and EU strike a deal. And Scott Anderson of BMO looking ahead to Wednesday's Fed decision. We begin this hour with our top story. President Donald Trump striking a trade deal with the EU. Our team coverage starts right now with Lizzie Burden in Turnberry and Oliver Crook in Stockholm. Lizzie, walk us through the basics of what we agreed over the weekend.
Well, this is a hole-in-one, John, maybe more for Donald Trump than Ursula von der Leyen, the European Commission president, dropping in to Turnberry yesterday to agree this deal, 15% US tariffs on most EU goods. As you note, that is higher than the other way round. But von der Leyen admits that they need to redress the imbalance in trade. Now, to get this over the line, of course, there had to be a sweetener to get the closer to get this deal. And that includes $750 billion that the EU is going to spend on US energy products, $600 billion that the EU is going to invest further into the US economy, and vast amounts of money to be spent on US military equipment. It still needs to go past all the EU member states, still needs to get that stamp of approval. There could be pushback, but for now, there is relief that there is certainty.
Ollie Crook, it's a big deal. It's a big agreement, and it looks very, very lopsided. How have the European member states reacted to this? I don't think we have his microphone. Ollie, we're going to come back to you maybe a couple of minutes' time, and we'll get that re-established. Ollie Crook there alongside Lizzie Burden with the latest. European member states signing up for something that doesn't look good.
And some of them are actually rallying around it and saying, great, good job, Friedrich Merz of Germany coming out with a really positive stance, a little bit less positive maybe from France. When you hear from the German automakers, maybe a little less exciting. When you're expecting a storm, when you're expecting a hurricane and you get just simply an average storm, maybe it seems better than you otherwise would. So a little bit of dissent on the margins.
Here's the view on Wall Street so far this morning. Steve Chiavarone of Federated saying the following: it's hard not to remain constructive with key headline risks behind us, economic fundamentals still solid, and companies that continue to beat expectations. Steve joins us now for more. Steve, good morning. Good to see you.
How are you?
We understand the tariffs. Do we understand the consequences?
I think what we've done is boiled the frog slowly, right? If you would have said a year ago that we were going to be at essentially a 15% kind of across-the-board tariff, I think markets would have had some digestion. But we kind of got there slowly, right? We got there through a big threat of even higher tariffs, and then we kind of settled in at 10, and now it looks like 15's that's the number. What will be the impact over time? Who knows? I think what we've seen, though, and what Wall Street's saying is that we can handle this, right? If you think about a 15% kind of across-the-board tariff on companies where maybe cost of goods sold are 60, 70%, you assume half of that is maybe borne by the U.S. taxpayer, maybe half of it is eaten up either through currency moves or foreign payers. Does it have an impact? Sure, but it's not huge. And on the other side of that tariff revenue was the ability of the federal government to cut taxes over the next 10 years somewhere in the neighborhood of $6 trillion. So all in, it looks like it's domestic stimulus, just not anything that's so large that it threatens the deficit or inflation.
So buy the rumor, buy the news. Is that essentially what everyone is comfortable with at a time when we haven't seen the full ramifications been borne out, but at the same time, it seems like companies are coming up with a path and enough visibility to give you confidence that they can manage through this?
Yeah, I think this week is kind of a microcosm of what's going to happen in the market. I think, tariff headline risk, there's still going to be some tariff headline risk, but the bulk of it's behind us, right? Most of the major trade partners are kind of in the bag in terms of deals now. The tax policy is behind us with the passage of the One Big Beautiful Bill. And now the focus shifts to the two things that are going to be in focus this week. One, the Fed, and what that path towards rate cuts look like. It's probably not this week, but it probably is something coming in September with maybe some dissents this week to preview that. And then secondly, earnings, because the market has moved significantly here. We're near a 23 times multiple on the S&P, which is fine if earnings continue to beat. And starting next quarter, we start getting those 2016 guidances that really start to come out and support where the market is. And so I think there is a little bit of a handing off of the baton here from trade and taxes to the Fed and earnings, and we'll see how it goes. So
when it comes to earnings, what do you have to see to get more bullish in terms of both guidance and in terms of what they're actually doing right now?
I think this quarter is not the important one, right? Coming into this quarter and the reporting period, you still had the uncertainty around tariffs. You still had the uncertainty around tax policy. It's really next quarter. So, this quarter, let's get through the rest of it. Right now, the beat rate's been good. 80% of companies have beaten. They're not necessarily beating by a huge magnitude, but it's enough to get through this season. It's really Q3, because now you'll have all of your policy pieces in place. And what we expect is you'll see a beat and raise, and this market will grow into its multiple. But we need to see that happen, starting in October.
Do you think investors will be in a forgiving mood in the meantime?
Well, they have been. If you look at the double beats this quarter, if you're beating on both top line and bottom line, your stock has done quite well. And the percentage of companies beating on the top line is greater than what you see on average. And so I think that's the story. We know underlying demand is pretty good. Market's a little bit more forgiving on the margin right now because of some of the uncertainties that have been in place. I think what really happens next quarter, though, is do I continue to believe in the 26 earnings number? Now, so far, it looks like estimates for both this year and last year have bottomed and are moving up. And if that trend continues, then I think we're still on solid footing.
Does that forgiving mood apply to the economic data as well? Because that's something we're trying to figure out going into Friday. Friday payrolls is an interesting one because you might get something north of 100K. And if we get something south of 100K, we'll get a lot of economists come on this program, tell Lisa, Annmarie and me that that's okay. That's a supply side story.
Yeah, so I think there's a couple of things that are at play here, too, and one of which is important, which is the market is preparing for a Fed rate cut. And when you're preparing for a Fed rate cut, data that's soft but not catastrophic can be viewed bullishly. And so I do think we're in that kind of scenario where if the economic data is so hot that it takes the Fed off of the table, that's bad. If it's so cold that it looks like the Fed is very much behind the curve. That's bad. Everything else in between, which is really the bulk of the probability, is viewed as okay right now. An economy that's slowing but not falling off of a cliff is one that you can invest in and where the Fed is likely to step in with rate cuts. And I think that's what the market is comfortable with right now.
So terrible news is bad news, but bad news is good news for markets. I know that Stuart Kaiser is having a very hard morning listening to this, throwing things at his screen, but, is that basically what you're saying?
I think an economy that's slower is fine. An economy that's falling off a cliff is bad. I think what we're seeing, though, in reality is an economy that is poised to reaccelerate a little bit. And we've seen that in some of the earnings reports and some of the commentaries, particularly from the airlines.
Have we grappled with the thought that the economy is not slowing down? And that, I think, is something that I see increasingly in notes, that maybe this is more inflationary over a prolonged period than many people had imagined, because the consumer is feeling better and more resilient. And frankly, companies are able to pass along some of the price increases. Everyone's maneuvering just fine. So why should the Fed be cutting rates, and potentially are we discounting the idea of inflation?
So I think you don't want to get caught in a false dichotomy of either it's bad or it's inflation. There's a third option, and it's the one that we kind of see, which is an economy that has kind of bottomed in terms of the consumer being under some pressure, uncertainty reigning, and maybe starting to reaccelerate. I think we are starting to see signs of that, but that doesn't necessarily mean that it's one that has a lot of inflation pressure building, because you still have a little bit of a looser labor market, hiring's a little bit slower. Goods prices are not showing any kind of big inflationary pressures, at least right now. And so we think it's a little bit of a kind of reinflating of the economy, but not necessarily a reinflation of inflation pressures in the economy. And so you could be in a scenario where earnings are growing and the Fed is able to cut, and then that becomes a really good environment for stocks, which is why as we look out, 12, 18 months, we can get this market that's at 6,500 today up to 7,500. That doesn't mean we don't have a breather here, because we have run so far so fast, but that's the direction of travel that we see.
You mentioned Kaiser. Stu said if we take a significant weakening in the data, and it would have to be a big one to concern equity markets, payroll sub 75K, unemployment rate above 4.3%. Anything other than that, we're okay.
It would have to be so catastrophic that even if the Fed did what the president would like and cut by 300 basis points, it still wouldn't be enough to really regenerate some sort of growth, which seems not only unlikely, but essentially has been written off by every investor in this market currently.
Steve, it's good to see you. As always, thanks for dropping by. Steve Chiavarone there of Federated. If you are just joining us, welcome to the programme. 5 consecutive all-time highs on the S&P 500. Could be in store for day 6. Equity futures right now positive by 0.25%, with an update on stories elsewhere. With your Bloomberg brief, here's Yahara Anand. Hey, Yahara.
Good morning, John. President Trump and European Commission President Ursula von der Leyen announcing a trade deal ahead of Friday's deadline. The deal will see 15% tariffs on most EU imports into the U.S. The EU also agreed to purchase $750 billion in American energy products and invest $600 billion in the U.S. And sticking on trade, U.S. and Chinese officials are meeting in Sweden to extend their trade truce beyond its August 12th deadline. It will be the third meeting in less than 3 months between Treasury Secretary Scott Bessent and Chinese Vice Premier He Lifeng. A breakthrough this week could set the stage for a meeting between Trump and Xi Jinping later this year. And Samsung Electronics will produce AI semiconductors for Tesla. Sources telling us here at Bloomberg, the deal worth $16.5 billion will run through the end of 2033. Musk confirming it on X, saying the $16.5 billion number is just the bare minimum and that actual output is likely to be higher. The win for Samsung comes as it moves to regain ground in chip manufacturing. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the programme, striking a deal with the EU.
We've reached a deal. I think you were saying this is probably the biggest deal ever reached in any capacity.
We have a deal, and it's a big deal. It's a huge deal. It's 15% tariffs across the board, all inclusive.
I think it's the biggest deal ever made. Thank you very much. Congratulations.
Up next, Terry Haines of Pangaea Policy, live from New York City this morning. Good morning. Looking ahead to a really busy week. Federal Reserve decision on Wednesday, big data point on Friday, payrolls just around the corner. In our survey, just a sneak peek for you, the median estimate is 109, the high is 170, the low, Stephen Stanley of Santander is looking for 0. That's not a typo, he's looking for 0 this Friday.
Would that be bad enough to be considered bad? And that, I think, is really interesting. If you pair that with where the unemployment rate is, if you pair that with sort of what people are expecting in terms of the supply of labor versus demand, I wonder if that would be enough to shock this market.
Might change the conversation going into Jackson Hole. Equity futures right now. In the equity market stateside, we're positive by 0.25% on the S&P 500. On the Nasdaq 100, up by 0.4. Under surveillance this morning, striking a deal with the EU.
We are agreeing that the tariff straight across for automobiles and everything else will be a straight across tariff of 15%. I think you were saying this is probably the biggest deal ever reached in any capacity, trade or beyond trade.
It is.
It's a giant deal with lots of countries.
It's the latest this morning. The US and European Union reaching a deal, averting a trade war before President Donald Trump's Friday deadline. The European Commission President Ursula von der Leyen saying it would bring stability and predictability. Bloomberg's Tyler Kendall joins us now from the nation's capital. Tyler, this looks like a major win for the president.
Yeah. Hey, John. Good morning. Well, the White House is definitely touting it as a major win as they add it to its list of finished frameworks, at least, along with Japan, as we sort of barrel towards August 1st and wait for some of these other trading partners to emerge. Now, a U.S. official does tell us that 15% tariff rate will go into effect on August 1st, this Friday, but we are still waiting for the finalized text of this deal. Really importantly, though, to point out, President Trump said the 15%, of course, extends to EU autos, something that we know was a really critical sticking point in these negotiations. But our analysts at Bloomberg Economics do say that there is still risk here when it comes to some other sector-specific tariffs. That includes metals. Our understanding is that they'll likely be tariffed under a lower levy for a certain quota, but then could snap back up to that 50% rate. And same thing goes for pharmaceuticals. There's still some big question marks there, including if those pharmaceuticals will remain tariffed at 15% even after we get a Section 232 investigation, which could lift that levy even higher. Now, of course, we know that the EU did give some major points to the United States here, including purchasing $750 billion in American energy, agreeing to a $600 billion investment on top of existing expenditures. And then, John, I'll also point out that the EU says that they will purchase vast amounts, in President Trump's words, when it comes to U.S. military equipment. That, of course, has long been a sticking point for this White House, trying to get European allies to boost their defense expenditures. So that's something that we were tracking and ultimately ended up in what seems to be this finalized framework.
Tyler, can we finish on China? And I'm not talking about the talks in Stockholm. Most people assume we'll get a 90-day extension. They'll continue. I'm talking about the potential talks between the Europeans and the Chinese. Do the Europeans now have to turn towards China and address the overcapacity issues alongside the Americans?
Well, that's something that we're definitely tracking here, because we do know that there's going to be a flow of these cheaper Chinese goods, and which sorts of markets will these end up going in. But the Europeans have said that they want to try to bid against that and not ultimately have to absorb that excess consumption. So it's something that we're going to be watching here as this does move forward, and as the U.S. is pushing for China to make its own structural reform, something that our analysts say at the moment isn't something that they really do expect to come out of these trade talks as they do kick off in Stockholm. There are a few different other areas of concessions, though, importantly, that the U.S. is looking for that I would say that we should focus our attention on, including when it comes to fentanyl. Perhaps this could be one of those main areas that we could see some sort of compromise on, since we know that about 20% of the current tariff against China is linked to fentanyl concerns. And we have seen China make perhaps some sort of concessions in recent weeks towards getting that number potentially lower, including curbing some of the main chemicals that go into fentanyl, John.
Tyler Kendall with the latest. Tyler, thank you. To extend the conversation, Terry Haines of Pangaea Policy. Terry, welcome to the programme. There is always a temptation to move on to the next thing. I just want to talk about the last thing for a little bit longer. Just frame what we witnessed over the weekend. To see a European Commission president accept 15% and essentially say thank you, we will rebalance, and almost apologising about the situation.
Well, it's a triumph of a lot of things. certainly the president ought to take a victory lap. I think it ends up being good for the European Union. It's a blow against the conventional wisdom, which, of course, in the last quarter saw a lot of this as disastrous. The markets see the fact of the deal and the ratification of trade and the expansion of trade as the most important thing. And number one. Number two, I think there's a situation here where, as you've alluded to in your questioning with Tyler, that the geopolitical element of this also remains front and center, whether we're talking about the continued interdependence of the U.S. and European Union economies, or whether we're talking about investments in the United States and purchases of military equipment. You're seeing a tightening of the alliance, and I think, frankly, an attempt by both parties to push back a bit against China.
Terry, just to build on that theme, we're hearing from the EU Trade Commissioner, Maroš Šefčovič, this morning in Brussels, and he commented on how overcapacity is destroying the EU steel industry. Overcapacity is sort of code from steel from China, and I wonder how much that is ongoing discussions that are happening now that have pushed Europeans to make this deal with the United States, even if it's being perceived by the market as being better for the U.S.
Well, they'll certainly try to make a deal on this, but at the same time, Europe sees and the United States sees as well. I think the China using economic sectors and industries as geopolitical weapons, and there's nothing more stark than China trying to flood the European market with EVs, for example. On this, and we even see, as Bloomberg reported recently, Starbucks under assault now by a Chinese coffee company starting in New York, vastly undercutting prices. So you'll see this, throughout, and it is a leitmotif of these trade deals and the fulcrum of kind of pushing back against China, limiting China's ability to try to use industries and sectors to, frankly, hollow out and destroy industrial capacity in the West.
What have we learned from both the Japanese deal and the EU deal in terms of the structure of the sustainable trade conversation going forward? Is it that 15% is the new floor and that you have to have some sort of investment fund alongside that, the details of which haven't really been disclosed on either side?
I tend to go outside in on this instead of inside out. And what I mean by this is I think markets, and I've said this many times on this program, I think markets are focusing entirely too much on tariffs and entirely not too much on the broader benefits of the rest of Trump trade and trade policy and tax policy, whether it be the tax bill and the variety of things that are coming from that, or these trade deals and how they're trying to reorient in ways that frankly continue and expand investment in the United States as a complement to onshoring and reshoring in critical industries,
Terry,
as Secretary Bessent puts it.
In fairness, though, stocks are at record highs. They've been reaching record high after record high. In what capacity are you saying that markets are not aware of some of the positive benefits from this?
Well, I'm saying that they haven't been, first of all. And second of all, I'm saying that there continues to be a focus on tariffs as a negative without the countervailing positives and attached. Certainly, markets have gotten over a lot of the tariff shock in the last quarter and got past the idea from the conventional wisdom that this was going to cause a hole in the economy. Now, your situation is, I think Steve put it very well in the last segment, is you've got a variety of hoops that have been jumped through, all of which are market positives. And now we're turning to, for example, the Fed this week, as well as earnings, to see if the proof's in the pudding on that side.
The narrative has changed quickly. Let's put it that way. Terry, appreciate your time. Terry Haines there of Pangaea Policy. Lisa said it last week, 15's the new 10. Victoria Green said the market's behaving as if 15's the new 0. This market's moved on quickly.
People seem to forget that we still see a tariff rate that's the highest since the 1930s. People are cheering it. Georgia Maloney called it sustainable, and maybe that is the bar that we're looking to hurdle.
The economic story is yet to be written, but it's quite a win for the president over the weekend. Up next, we'll catch up with the former Trump trade official Kate Kalutkiewicz, plus Danny Berger with your Morning Movers. The equity market bulls are feeling good this morning. John Stolfus over at Oppenheimer, 7,100, up from 5,950, a new street high. S&P 500 price target. Your futures look like this. Equity futures on the S&P up by 0.2%. On the Nasdaq up by 0.4 with 3 hours until the opening bell. Let's get you some morning movers and cross over to Danny Berger. Hey, Danny.
Hey, John. We also have some specific industries rallying off the back of that U.S.-EU deal. U.S. energy output producers also among them, specifically those ones that look like they produce LNG. $750 billion is what the U.S. announced that the EU would be buying in U.S. energy products. The EU also confirming that, saying that they look to replace some of their Russian energy with that of the U.S. So some of these shares up as much as 6%, Venture Global up 6.8%. Trump also saying that the EU would be buying, quote, vast amounts of U.S. arms. So some of the defense companies in the U.S. also rallying. Lockheed Martin up 1.4%. I should also note that the European defense companies are falling off the back of that. Finally, some individual company news. Tesla and Samsung announcing a pact where Samsung will produce Tesla's next generation of AI chips. $16.5 billion is the price tag on that deal. Elon Musk saying that it's hard to overstate the importance of this agreement and that it is likely just the baseline number in the agreement. It might go further than that. Samsung, those shares in Asia also rallying, John.
Danny, thank you. Thanks for the update. More from Danny in the next hour. On our radar this morning, our top story, the EU striking a trade deal with the US, agreeing to a 15% levy on most exports starting on August 1st. President Donald Trump calling it the biggest of all the deals.
Yeah, and we heard from Ursula von der Leyen. It's a huge deal, major deal, big deal. Definitely the discussion that she had with President Trump. Look, it raises a question about 15% as the new floor. What this does to European companies. We heard from the auto manufacturers saying, look, it's better than 25%, but there still are a lot of questions. And the Germans' main lobby said it sends a fatal signal to the closely intertwined economies on both sides of the Atlantic. The story still has to be written. I think it's interesting, the investment funds, and I want to see what exactly that means. And then, as you were saying earlier, there are certain expediencies, like the security of an entire continent. They need to buy weapons from the United States. They don't have any other option. They need to buy LNG from the United States. This is codifying it and creating a win for President Trump.
As you've pointed out, a couple of things we still need to know: how much pushback we'll get from member states across Europe. That's still to play out. In addition to that, I would say watch this space on the sectoral tariffs. Are we really all-inclusive? Is it 15% all-inclusive, or is there going to be another fight further down the road?
This isn't including steel, metals in general. It's also not including pharmaceuticals, right? So that's a big question mark. And what we heard from Ursula von der Leyen is, well, we just don't know, and we'll have to see what we see. There also are the sectoral tariffs and some of the reviews, as you were mentioning. That's going to come to the fore. We don't understand the reference to that. There's also a court case later this week to understand the legality of some of these trade wars by President Trump using IEEPA, what they're currently using. If that gets overruled in any capacity, how does that upend a number of these trade deals?
How binding are these purchase agreements as well? These investment agreements, not just with the EU, but with Japan. But all that aside, the fact of the matter is you've got the Europeans to accept 15%, and there is nothing in terms of retaliation. That's a win.
And that's the reason why you're seeing the dollar strengthen versus basically everything, and you're seeing the euro weaken. At what point, to Terry Haynes' point, has the world viewed the tariff, the trade war by the United States as a negative for the United States, and how much is that shifting just slightly as people start looking at the details of some of these deals?
Let's go from Scotland over to Stockholm. US and Chinese officials meeting today in Sweden to extend their trade truce beyond a mid-August deadline. The Treasury Secretary, Scott Bessent, leading negotiations for the US, with most people expecting a 90-day extension.
Yeah, that's what Chinese media are reporting over the weekend, that is the expectation. It feels to me like they make an agreement, and then they tighten the screws on exactly the aspects of that agreement, and then they make an agreement to go back to the original agreement in order to create a sustainable flow of trade that can maintain the industries, whether it's parts of planes for China or whether it's rare earth metals for the United States, and put that on repeat. It feels like we just do that again and again, and that's what we're doing this morning in Stockholm.
The market's comfortable with that. Just keep it going. Extend and pretend. Kick the can.
It seems like this market just doesn't want April 2nd once again. I mean, essentially anything but April 2nd is really great. I mean, we're talking about a worst case scenario of average tariffs of 18%. Now there's close to 16% with this deal, and everyone's cheering, saying, well, it could have been worse. It sort of raises the question, do you buy the rumor and buy the news because it could have been so much worse?
That's the latest on the trade front. Wanted to squeeze in this story. Samsung striking a $16.5 billion multi-year deal to produce AI chips for Tesla. The CEO, Elon Musk, confirming the deal on X, writing the following: the strategic importance of this is hard to overstate.
So two aspects here. One, the desire to diversify away from Taiwan Semiconductor Manufacturing Company, TSMC, because they are in a particularly perilous place, but also because they don't have the capacity to manufacture anything extra, number one. Two, the difficulty in doing that, because Samsung has lost share as their foundry, and how difficult it is to break into that. What does this mean for Intel? I know, I feel bad for them, but they're getting out of this business, but it just shows how hard it is to break in. At this point, how much does this give Samsung a bit of a leg higher?
Tesla up in a pre-market by 1.5%. Let's stick with autos. Volkswagen's Audi cutting its outlook, citing tariffs and restructuring costs. The news coming after the EU and US announced a trade deal with 15% tariffs, matching last week's deal with Japan. Bloomberg's Craig Trudell joins us now for more. Craig, welcome to the programme, sir. What position does this put the industry in this morning following the agreement over the weekend?
Yeah, I think in short, it's going from a really, really bad situation to just a really bad situation. A 6x increase in the percentage, that you're being charged, and from a import duty perspective, is better than 11x, right? And yet it's still going to be really impactful for the likes of Audi and the Volkswagen Group, which, the sort of parent of the company also came out with reduced guidance last week. And we're seeing this affect not just the European manufacturers, but also U.S. companies like GM, where, I think it's underappreciated the extent to which, GM, as we've talked about on this program, imports a heck of a lot of pickups and SUVs from Canada and Mexico, and they also import some of their cheaper models from South Korea. So this is having, far-reaching ramifications for this sector. We're seeing some relief rallying going on, but even that has been short-lived, where we saw, a real rally in European stocks off the Japan deal last week. And some giving back of that today for some European manufacturers during today's session.
GM up this morning by 0.6%. Ford up by about a quarter. Craig, thank you, sir. Craig Trudell out of London. The former Trump White House trade official Kate Kalutkiewicz says the US automakers won't be happy. Kate joins us now for more. Kate, welcome to the program. Can you just explain that? Why they'll be unhappy with what's been agreed?
Well, I think they're trying to find some positives in this. On the one hand, of course, President Trump has pushed very aggressively for trading partners to open up their markets to U.S. automakers and U.S. exports. But at the same time, he's granting these lower tariff rates even after he, gave the U.S. automakers a gift with 25% tariffs earlier in the year. Each trade deal seemingly erodes that bit by bit.
So at this point, do you think that this is going to not necessarily increase their market share, increase their capacity to produce in the U.S. with manufacturing coming back to the U.S., and it just means that it levels the playing field with Europeans?
It could. U.S. automakers, I think, are waiting, as are many, for discussions to kick into gear with Mexico and Canada. I think everyone is aware that the North American value chain is very important for the U.S. automakers. And we've had a bit of lag time in discussions with our North American partners. So every time a trading partner like the UK secures 0% tariffs for a range of its autos, and Japan and the European Union get lower than the 25% rate, they're a bit anxious about what that means for the market here in the US.
I'm struck by some of the commentary coming out of EU Trade Commissioner Maros Sefcovic this morning. He said a number of times that this is the beginning of a process with the United States, with talks. He's talking about how 0% EU-US tariff list remains open to additions, as though this is just the beginning of a negotiation, even though the market is taking this as the end of the negotiation. Can you sort of square that difference?
Well, there's still a lot of detail to hammer out here. And this is, of course, what happens when a leader level discussion wraps something up. The trade negotiators themselves are going to have to come hammer out the details. And I am struck, of course, by the difference in the statements by the European Commission around this notion that there will be additional tariff liberalization. I suspect that may be hard to come by. I think the United States is probably done with Europe for the moment and will be moving on to other trade negotiations. But it would be a positive development if we could find some more 0 tariff talk. I mean, not only with Europe, but other trading partners. I just don't see that in the near term.
So, Kate, we've made progress with the Europeans, with Japan, and maybe we kick the can with the Chinese. There's two big nations left, Mexico and Canada. The trade relationship with them is yet to be defined. How do you think that's going to land? Where do you think we will land in the next 12 months?
Well, I'm hopeful, and I remain bullish about North America. I mean, I think for President Trump, despite, his, I think, core belief that we can make everything in America, he does recognize that North America is critical for the long-term success of the American manufacturing sector, particularly when we think about China. We have built this very productive value chain, and it would be really dramatic to pull the rug out from under companies that have made these investments. His administration has acknowledge this through a series of exceptions. But I do think Mexico and Canada were quite shocked when they received those tariff letters. And absent some change, we will see an increase of tariffs on Mexico and Canada this Friday. Those leaders have been very willing to negotiate with the president, particularly on these fentanyl tariffs. And I'm very hopeful that now that we've got the European Union completed, they'll have their chance to get to the president.
As we know, the White House has been very upset about so-called transshipping. That's been a story through Mexico for a long, long time now. They've been pushing other nations to do something about that, Kate, both transshipping and Chinese overcapacity, which is the source of the issue. Kate, are you hopeful that the US has now got a coalition of the willing, if you will, to do something about Chinese overcapacity?
I do. I mean, I think this has been probably the most significant component of these agreements is this recognition that goods that have a significant amount of content from China will be treated differently. I think that this year, when we return to the negotiating table with our USMCA partners, Mexico and Canada, we will see a significant focus on this so-called rules of origin to ensure that goods of North America are really goods of North America and not a secret way for Chinese imports to make their way into the United States. The good news is that I think Mexico is willing to play ball here and really willing to work with the United States to ensure that Chinese goods are not being transshipped. But this very much will be the central part of those negotiations.
Kate, appreciate you jumping on this morning. Thank you. Kate Kalutkiewicz there, the former Trump trade official on the latest. This is the latest. Lisa mentioned the trade chief over in Europe. The US deal is not only about trade, it's also about security and Ukraine.
And this goes directly to the $750 billion of purchases in energy, as well as the military purchases that they have on deck as they try to fortify the region from the threat of Russia. What else are they putting in there? I mean, again, it just puts in the question of other details. You think about, for example, China. How much is their agreement really going to be tied to not buying oil from Russia? Is that something that's similar with some of the discussions with Europe and as well as the U.S.?
A lot to work out this morning, that's for sure. Futures just about positive still, up by 0.2% with an update on stories elsewhere. With your Bloomberg Brief, back with us, here's Yahara. Hey, Yahara.
Hi, John. The leaders of Thailand and Cambodia began talks for emergency peace talks after President Trump threatened to withhold trade deals unless fighting stopped. A border conflict that broke out last week has become Southeast Asia's deadliest in a decade. More than 30 people have been killed and 150,000 displaced. Meanwhile, Mark Zuckerberg is escalating his AI hiring spree. The Meta CEO announced on Threads he hired ChatGPT co-creator Shenzhe Chao as chief scientist of his superintelligence labs. Chao will set the research agenda and scientific direction for the lab, which aims to build new AI models that can perform tasks as well as or better than humans. And Tadej Pogačar is once again a champion in an exciting race. The 26-year-old Slovenian blasted his way to his fourth Tour de France title, beating rival and two-time Tour winner Jonas Vingegaard amid challenging weather and hazardous road conditions. Pogačar previously won the Tour de France in 2020, 2021, and 2024. That's your Bloomberg Brief. John?
Yahara, thank you. I cannot think of a harder sporting event, can you?
I was just thinking.
It's ridiculous.
I was just looking up, what is the average resting heart rate of somebody who competes in Tour de Force? It's in the low to mid 40s and even as low as the high 20s.
That's just nonsense. They're barely alive.
Well, that's exactly it.
Right?
Because they have to be barely alive so that they can be, basically functional as they do something that is, a superhuman feat.
Ridiculous. Futures positive. We're up by 0.2%. Big week still to come in this market. Up next, piling the pressure on the Fed.
It looks like it's about 3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
Yeah, I haven't heard that from anybody at the Fed.
Up next on the program, Scott Anderson of BMO, live from New York City. This is Bloomberg. I mentioned John Stolfus over at Oppenheimer looking for 7,100 on the S&P. Morgan Stanley and Mike Wilson reiterating they're looking for the bull case, potentially 7,200 over the next 12 months. The bull's getting more fuel over the weekend, apparently.
They got stability when it came to some of the rates, and frankly, it's not the worst case scenario. Just to put into perspective, Stolfus's year-end target would be the third consecutive year of more than 20% gains on the S&P 500, so it kind of flies in the face of all of the naysayers who try to be bears at the beginning of every year.
Imagine saying that on the afternoon of April 2nd. And the carnage that followed in the week afterwards.
And imagine if you understood where we were going to end up with the tariff rate, would you still have been able to understand what kind of rebound we would have seen? Or have the goalposts been moved so much that this market responds to tariff news very differently than it would have?
A lot's changed in this market, higher by 0.2% on the S&P 500. Big week ahead under surveillance this morning, piling the pressure on the Fed.
We're just taking a look at what's happening. You know, it's a tough construction job. It looks like it's about 3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
Yeah, I haven't heard that from anybody at the Fed. You're including the mortgage renovation. You just added in a third building is what that is. That's a third building.
Well, no, but it's a building that's being built.
No, it was built 5 years ago.
It's part of the overall work.
So,
well, I'd love him to lower interest rates, but other than that, what can I tell you?
Here's the latest this morning. The Federal Reserve and Chair Powell under an uncomfortable spotlight this week. Scott Anderson of BMO writes, stagflation light still appears to be the U.S. economy's most likely path and should allow the Fed to look through some of the inflationary effects of tariffs in the months ahead. Scott joins us now for more. Scott, welcome to the program, sir. How are they going to navigate these issues at Wednesday's meeting?
Well, I expect Fed's playbook isn't going to change a whole lot from what he's talked about in recent weeks. He's really going to highlight the risks to the dual mandate, full employment and stable prices. While the markets are celebrating the lower uncertainty on the reciprocal tariffs, we're still looking at substantial tariffs. We think the average effective tariff rate in the U.S. will land somewhere in the 15 to 20% range, probably closer to the 15% level, but that's significant. That's more than 6 times where it was last year, and we're going to still see some price effects from that before the end of the year.
Scott, what do you make of the difference that we get in tone from the markets reaching new highs, optimistic, raising price targets, most bullish estimate, and economists who are coming out and saying, just wait, you haven't seen the ramifications, they're going to be bad, and just wait until the second half of this year?
Well, I do think the tariff truce had a lot to do with it, after the April 2nd Liberation Day where there was panic in the markets and we've seen, the expectations of the markets pretty much playing out. We've had a slow roll on the inflation effects from the tariffs. The second quarter looks like inflation. We saw a nice move down in prices, largely due to energy, though, not really any relief on the goods price inflation. And we really haven't seen a lot of the price effects hit yet. And most economists didn't expect to see them for another 2 or 3 months. And that's part of the reason why the Fed remains on hold. And while even September looks like they may be able to look through some of the tariff effects there, we're probably still not going to peak on inflation until the end of the year. And we really won't see any relief on prices probably until next year sometime.
At the same time, we are expecting 2 dissents on Wednesday, and potentially it's going to be the first dissents that we see from Fed members going back to the 1990s at a time when there are real questions about the politicization of the Federal Reserve swirling. And frankly, there's a real economic argument to be made that, yes, we are going to see some inflationary impacts, but they're going to be a one-time price adjustment, not the beginning of an inflation spiral. And we're seeing other Fed members, apart from those two, really coalesce around that idea. How viable do you think that is? I mean, do you think that you as an economist could sign up to a rate cut as soon as September, another one by the end of December, and a couple more next year?
That's exactly what we're forecasting. We do think we'll see a cut in September and in December, and there's a possibility of even more cuts next year. We've got 4 quarter-point cuts in our forecast, which is a little bit more aggressive than what the markets are currently pricing in, and a lot different from what the FOMC said, the median forecast back at the June meeting. We really had the FOMC members in two camps coming out of the June meeting. We had 7 FOMC participants that didn't want any cuts at all this year, but there were 10 that were looking for 2 or more cuts by the end of the year, but only 1 cut expected for 2026. So the markets are factoring in maybe a new Fed chair, a more aggressive rate cut path next year, and I think that's probably the right call.
Scott, when they meet on Wednesday, they won't have the payrolls report. That comes out on Friday. The range is pretty wide this time around. The high end 170, the low end 0. You're close to the median of 109. Scott, you're 114. Is that the new normal for this jobs market?
Well, we do think the labor market's slowing down. Hiring has certainly cooled off. We're not seeing the layoffs, though. And in fact, initial jobless claims, the 4-week moving average is moving down for the last 5 weeks. So a big range of forecasts here coming into the meeting, coming into the payroll report on Friday. Partly because of that, we're getting mixed signals, mixed messages from some of the more timely indicators here. But we do think the path of least resistance for the labor market is more cooling, and maybe even a tick up in the unemployment rate to 4.2 from 4.1 last month. Nothing to get too alarmed about here. No sign of a recession on the horizon, just more rebalancing of the labor market that the Fed's been looking for.
That introduces some daylight between you and Governor Waller. Governor Waller looks at the same data and he says this is a labor market on the edge. Scott, if you're in conversation with him around the table on Wednesday, how would you convince him otherwise?
Well, I'd say that we've been fooled, right? I mean, I think a lot of people have called recessions over the last year and a half, and they really haven't materialized. I mean, we've all been surprised by the strength and resilience of this expansion and the labor market overall. And I think that's the right side of the bet here. There's obviously risks on both sides of the dual mandate, but the labor market continues to surprise on the positive side. And so that's part of the reason why I think the Fed and Jay Powell thinks they can be patient here.
Scott Anderson of BMO. Scott, appreciate the update on the Federal Reserve and the economic data still to come over the next week or so. This is the first time in a long time we're going to have 2 governors potentially dissent and 2 governors enter the meeting making a case for an interest rate cut that Chairman Powell is not quite prepared to deliver.
What I'm curious about is how many other members, not just Mickey Bowman and Chris Waller, sign up to the same idea, because we're hearing something similar from the likes of Mary Daly, that she's coalescing around this idea that it's not necessarily a long-term inflationary impact, but rather a one-time price shock. And if you start talking about that and then you look at edges of coolness on the labor market, it starts to look like a different picture.
And then it comes down to emphasis in the news conference. Will the chairman choose to emphasize the firmer goods prices, or will he choose to emphasize the softer services prices? Then you can start to get a read on how he feels about the incoming tariff effects of the next few months.
Yeah, I think that right now people are going to have one question. How do you message any kind of hold at a time when you're on the chopping block and it's unclear whether or not you're going to get bullied by the president once again about not cutting rates? So it really is going to be so heavily political that I don't know how much nuance there's going to be room for in terms of, are you emphasizing this particular type of inflation? I'm just saying, that's probably, that's going to be the focus, right?
After September, we'll probably know who the next Fed chair is.
Exactly.
And we'll stop listening to Chairman Powell in 2026.
Maybe there'll be another Fed chair on the Fed right now.
Exactly. Up next on the programme, Jay Pawlowski of TPW, Henrietta Treyz of Veda Partners, the English Premier League CEO, Richard Masters, and Ed Al-Hussainy of Columbia Threadneedle.
The reality is that the economy is decelerating.
I have real trouble, both with weakness in the labour market and with a more hawkish Fed, that really changes the picture.
There's these underlying cracks in the labour market.
The labour market has held up reasonably well. And of course, on the other side of that, you have inflation.
I think the Fed is set up quite well to start some semblance of cuts.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
What a week coming up. Live from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P just about positive by 0.1% this morning, up a third on the NASDAQ. The NASDAQ in focus this week. What a lineup of earnings. We'll have numbers from Meta, Microsoft, Apple, Amazon. It's my favorite week of the quarter. You don't just get that, you get this. You get payrolls Friday and a Federal Reserve decision coming up on Wednesday.
Yeah, so take your pick. This is the moment of truth. I keep going back to what Julian Emanuel of Evercore ISI said about this week, because we really understand both the earnings picture with the busiest earnings week for the S&P 500 of Q2. We also get the Fed, how they manage some of the political pressure and exactly what they're looking at. I wonder how valuable it'll be from an economic perspective versus a political perspective. And then the jobs number. And you raised a really good question. How high is the bar for this market to care on a downside surprise? And what kind of upside surprise would matter from an inflationary perspective?
How forgiving is this market going to be? On the earnings, on the data, we know what the tariffs are. How well understood are the consequences through the rest of this year? As we've said repeatedly through this morning, that economic story is yet to be written, and we're going to see the consequences potentially in the next few months.
Both analysts and economists say we won't necessarily see the ramifications, the full ramifications from tariffs until Q3 or Q4. If that's the case, how much visibility are we getting from companies, not just about the remainder of this year, but 2026, especially at a time where Lori Calvasino has been really good on saying, we're all looking out to 2026 and ignoring the next 2 quarters. So you start putting that together. Do we get some visibility into the following year? And also, do we get a sense of how much companies have visibility for the remainder of this year at a time where I got to say, I'm punching into ChatGPT. What is the tariff rate for any given place? And it comes up with lots of different numbers, but it doesn't really have a clear sense either.
Before we get too confused, let's just take a beat on what took place over the weekend. It looked like the European Commission president was in a hostage situation, accepting a 15% tariff, no retaliation, everything on the president's terms. Everything. No retaliation, 15% tariff, a major win for the White House.
Yeah, a huge investment in energy, a huge investment in U.S. companies, a huge investment in military goods, and this feeling that they are aware that there are sectoral tariffs coming for metals as well as pharmaceuticals, and they're just going to have to eat that. It raises a question of whether this is essentially a win for President Trump, that he set the bar so high when it came to the tariffs, the potential ramifications, that they had to accept this and then talk about it as though this was a win for them and try to say, look, this is the beginning of a negotiation, as they're trying to say with the EU Trade Commissioner this morning. You just wonder about the specific companies and what they say, because we're hearing a little bit of a different tone from them.
And we've achieved all of that with equities at all-time highs. Amazing. Futures positive by 0.2% this morning. Coming up this hour, we'll catch up with Jay Poloski of TPW Advisory, with stocks on a 5-day winning streak, Henrietta Treyz of Veda Partners on the US-EU trade deal, and Al-Hussainy of Columbia Threadneedle on why the Fed might delay cutting rates. We begin this hour with our top story. The US and EU striking a deal.
We've reached a deal. It's a good deal for everybody, I believe. And I think you were saying this is probably the biggest deal ever reached in any capacity, trade or beyond trade.
It is.
It's a giant deal with lots of countries.
Our team coverage starts right now with Lizzie Burden in Scotland, Ollie Crook in Stockholm. Lizzie, from our vantage point, it looks like the president got everything he wanted and some.
Are you surprised, John? The point of this was to redress the imbalance in trade between the US and the EU. And of course, to get any deal over the line, to get that certainty, Ursula von der Leyen, the European Commission president, was going to have to give a sweetener. And in this case, it came in the form of that $750 billion pledge to spend more on American energy, and then some. And so for many in Europe, this is at least certainty. For others, it is just not what they wanted at all. Next up is going to be UK Prime Minister Keir Starmer. We're expecting him to arrive in the next hour here at Turnberry to be greeted. Of course, he already got his deal back in May, but there are plenty of details to be ironed out, including on steel. And our expectations have already been lowered there from the UK Business and Trade Secretary, Jonathan Reynolds, saying there isn't likely to be a breakthrough. But maybe they also talk about Gaza. You've got lots of pressure, international and domestic, on Starmer to press Trump to revive those peace talks. Does that pressure become insurmountable today?
We've got a range of issues to work through. Ollie, I just want to start with the first point. The ability of European member states to accept what was agreed to over the weekend. Are we going to see any pushback from Spain? Any pushback from anyone?
Jonathan, you will hear some pushback. You will hear some verbal criticism over the deal that was struck yesterday. But the reality of the situation, I think, for most European leaders is that this is the only deal that was going to be on the table, and this is the only deal that they were going to be able to accept. I mean, and when you think about 30% tariffs, which was the threat for the end of this week, this looks like kind of a good deal. On the other hand, as you've pointed out, if the base case was the initial negotiating position was 0 for 0, you ended up with something close to 0 for 15, and that is not going to make a number of people happy, particularly domestically in so many of the countries, whether it's Germany or France, where you have a large sort of right-wing population and political establishment that is pushing back already against what we've heard. We've even heard from the political establishment in France, the prime minister, who says that basically the bloc has resigned itself to capitulation and to submitting to the United States. We heard from Alice Weidel from the far right within Germany saying that this is not an agreement, but a slap in the face for European consumers and producers. And then Marine Le Pen, something very similar, saying that this is a political, economic, and moral fiasco for the Europeans. So those are some of the views that we're getting after we've got this deal. That being said, there is a realization within Europe that potentially this was not really going to be, there was not going to be a much better deal associated with this. There is some sort of silver lining. We were expecting slightly higher rates on autos. They came down to 15, so the Germans can call that a win. But again, at the end of the day, this is a really mixed bag for the Europeans. But again, like with so many things in the Trump administration, this continues to reveal some of Europe's impotence on the issues of the economy, but also geopolitics globally.
It's really notable that Ollie, Lizzie, you're both in Stockholm and you're in Scotland. This idea that the two poles of these discussions have to do with Europe and with China. Lizzie, I would love your take on how much what we have seen from this deal is the Europeans understanding what a threat China is and overcapacity and imports to the region, and how much that was really a big part of all of the discussions that took place this weekend.
Well, of course, the European Union faces that threat of China dumping goods on the continent. And we've got that question discussed at the ECB, of course, when it comes to the inflation picture, the disinflation picture for the euro area economy. Interesting to hear from ECB policymakers saying that this US-EU deal means that actually there should be a hold in the September meeting. But look, when it comes to this deal, as Ollie said, many of them just wanted certainty, and it seemed to be the best that VDL could get.
Meanwhile, Ollie, you are in Stockholm, and there is this expectation that we're going to see a 90-day extension of the U.S.-China trade truce. Do we have an understanding of what is going to be discussed then? Is it going to be when Xi Jinping and Donald Trump are going to meet? Is it going to be in South Korea? Are we going to hear about the dynamics of what China's relationship is with Russia at the same time that issue with Russia and Ukraine is very much a discussion with Europe and the U.S.?
Yeah, in some way, this is going to lay the groundwork for something like what we got with the EU with China, but that is going to take a much longer time. As we know from the Trump administration and from Trump's election campaign, fixing the trade relationship with China is central to his geopolitical ambitions. It is one of the promises he's made to the voters. So they're going to take their time. It's going to be much more considered, and they're going to take their time with striking that kind of agreement. What we need to remind ourselves, because it's very hard to keep track of all the numbers flying around on tariffs, the U.S.-China tariffs currently are at 30%, but that is a pause. That is a truce in the conversations that are going on between China and the United States. That would kick back up to 125% by August the 12th if you do not get an extension of the truce. And that is what the expectation is when we have Scott Bessent arriving here in the next couple of hours, meeting with the vice premier of China to discuss getting a truce in place, potentially another 90 days to continue their negotiations. But they're going to take their time. They're going to talk about fossil fuels, the Chinese position towards Russia, towards Iran. There's going to be discussions potentially about TikTok. Remember, Trump says there's a buyer in the United States. It still needs to sign off from the Chinese. But as ever with the Trump administration, the trade discussion is a way into a conversation about a mosaic of other issues. And those are the conversations that will be happening right behind me here at the Swedish Prime Minister's office between the Chinese and the United States to pave the groundwork. Ultimately, it's hard to imagine signing a deal between China and the United States where it's not Xi Jinping and Donald Trump in the room together.
Ollie Crook, appreciate it. Ollie Crook in Stockholm, Sweden. Lizzie Burden in Turnberry, Scotland. We'll be looking to Scotland in about 20 minutes' time when the President of the United States will be greeting the UK Prime Minister, Sir Keir Starmer, in Turnberry, Scotland, in about 20 minutes from now. We'll bring you some of those live pictures when they come in. Quite an achievement for the President of the United States. A 15% tariff, and Ollie mentioned Scott Bessent, the Treasury Secretary. Rebalancing that relationship between the US and the EU was point one, but a bigger effort was to rebalance the issues in China, and maybe they've actually got a partner that will help them do the same thing.
What's fascinating is the juxtaposition of what's going on in Scotland and Stockholm, the idea of getting some sort of agreement with Europe, reducing the temperature, and understanding that they've got a common threat when it comes from overcapacity in China, just heading into the renegotiation of that agreement with China. I just wonder how far you can get. What is the sort of threshold to get a deal over the finish line, to just even extend that pause from going up to 125,000% or whatever it is, or it was on August 2nd?
Should also say on this occasion, a benefit of not being in the EU. The UK probably feeling pretty good about that deal a few months back.
Especially considering a pretty special relationship that they have. Of course, there is a surplus. It does raise a question, though, about what type of benefit a number of nations are going to get from the European Union. And watch this space over the next couple of weeks. Who does start to dissent? You pointed out Spain. They've had a very different take than other nations when it comes to China, when it comes to the European Union, when it comes to a whole host of different policies.
How much pushback are we going to see in the weeks to come?
Yeah, exactly.
We'll see. So far, so good for the equity market. All-time highs coming into Monday. Futures up this morning by 0.2%. The gate's fading just a touch. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. As Ollie was discussing, U.S. and Chinese officials are meeting in Sweden today to extend their trade truce beyond its August 12th deadline. It will be the third meeting in less than 3 months between Treasury Secretary Scott Bessent and Chinese Vice Premier He Lifeng. A breakthrough during these talks could set the stage for a meeting between Trump and Xi Jinping later this year. Meanwhile, Boeing is preparing for factory workers to strike at its St. Louis defense hub after they rejected a contract offer. The International Association of Machinists and Aerospace Workers said its members overwhelmingly voted against the new terms that would have boosted their wages by 20%. Boeing has activated its strike contingency plan. And Heineken shares are dropping 4.6% in European trading. The Dutch brewer saw a decline in beer volumes due to disputes with regional buying groups over price increases that lasted longer than expected. Heineken noted there would be some impact from tariffs on U.S. profits in the second half of the year. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next, trade war averted with the EU.
We've reached a deal. I think you were saying this is probably the biggest deal ever reached in any capacity.
We have a deal, and it's a big deal. It's a huge deal. It's 15% tariffs across the board, all inclusive.
I think it's the biggest deal ever made. Thank you very much. Congratulations.
Up next on the programme, we'll catch up with Henrietta Treyz of Veda Partners and get you the view from the nation's capital with Tyler Kendall from New York City this morning. Good morning. Massive week for earnings coming up. Meta, Microsoft, Amazon, Apple, 4 names making up 1/5 of the index, 1/5 of the S&P 500 across 4 tech heavyweights. Those heavyweights reporting across Wednesday and Thursday.
That's $11 trillion of market capitalization and a couple of key questions that could be answered, or at least begun to answered, when it comes to what kind of capital investment these companies are making. To me, that's the biggest question, because if you look at overall S&P valuations, they are baking in structurally higher margins that are going to come from artificial intelligence, technological gains, and some of the investments that you're seeing in the likes of Alphabet that increase their expenditures for the period. To me, these are the types of things to watch that have been driving the overall equity indexes in a way that feels a little divorced from the will they or won't they put tariffs on.
Max 7 names coming into this week at record highs, very close to those levels this morning. Equity futures positive by 0.2%. Under surveillance this morning, trade war averted with the EU.
We are agreeing that the tariff straight across for automobiles and everything else will be a straight across tariff of 15%. I think you were saying this is probably the biggest deal ever reached in any capacity, trade or beyond trade.
It is.
It's a giant deal with lots of countries.
Here's the latest this morning. The US and European Union are making a deal before President Trump's Friday deadline. The European Commission President, Ursula von der Leyen, saying it would bring stability and predictability. Bloomberg's Tyler Kendall joins us now for more. Tyler, we imagine the White House is feeling pretty good this morning.
Yeah, hey, John, they definitely are. And this is considered to be a pretty consequential deal, considering that the European Union does make up about 20% of total U.S. imports each year. And the White House was able to do this without any of the planned retaliation that we kept hearing about from the European Union that was expected to target some politically sensitive goods in the U.S. Now, importantly, when we look at the details that we have gotten, the president says that 15%, that will be extended to EU autos. I bring that up because we know that was a really critical sticking point on the European side of the negotiations. But still, some of the biggest questions remaining about this deal do really have to deal with those sector-specific tariffs, like pharmaceuticals, whether or not that will see a higher rate when the Section 232 investigation is completed, and then also details surrounding metals. Our understanding is steel and aluminum will likely face a lower tariff rate under a certain quota, but we still haven't gotten those details yet. And we know that is really top of mind and has been a big part of these negotiations. We even had the EU's von der Leyen in a statement afterwards say that the trading partners will together, quote, face the common external challenge of global overcapacity when it comes to steel and aluminum, amid, of course, threats about China flooding the market with cheap metal exports. So that's something that, of course, we're still going to be watching for because we do need additional details about this deal. I will say that when we look at the sort of broader picture here, it does seem like we're trending towards a 15% tariff across the board. I will add, John, I did mention to Peter Navarro, I asked him last week on Bloomberg Television whether or not 15% is the new baseline. He called that aspirational, and it all depends on what our trading partners are able to put on the table.
Tyler, appreciate it. Tyler Kendall down in Washington, D.C. Thank you. Joining us now to extend the conversation, Henrietta Treyz of Veda Partners. Henrietta, welcome to the programme. Let's just start with that 15% and the so-called deal over the weekend, in principle at least. How inclusive is that deal of the sectoral tariffs that are still to come?
The sectoral tariffs are probably paramount for investors right now. Everybody has come to understand that, this is sort of a birth announcement, and congratulations, it's a border adjustment tax. So we have a 15% across the board consumption tax. It's about $2,500 per family in the United States that they'll be paying. But the sector analysts on pharma are most keyed into the details here, which President Trump did not provide and which are not yet available. In the next 2 to 3 weeks, we're going to have to hammer out the details of that because the investigation will be released. We'll get at minimum sort of an executive summary of what Commerce has found there. And we need to know what it's doing on generic drugs, what it's doing on intellectual property out of Ireland. We have outstanding issues of this with Switzerland, with India, with China. It's a gigantic component of this, and there are no details yet.
So given that everyone's now an expert in Section 232 tariffs, as well as IEEPA, and understanding the difference between the two, I just wonder what kind of curveball it is on Thursday if we get some sort of federal appeals court ruling that knocks down some of the use of the IEEPA tariffs and throws a real kink into some of these agreements that have been hammered out.
Yeah, you really have to wonder, are these tariffs that the president is getting the EU to agree with going to be anything with staying power? The deal with these lawsuits is that it doesn't undermine the trade agreement that the president has put in place with the EU per se, but it does require the president to start paying back any of the importers who pay the tariff when they import a product from the EU. So as fast as the money is coming in, they're going to have to turn around and write a check back to the company that has paid the tariff and pay them back. So it is literally a wash. That is the risk. The Court of International Trade unanimously found that the tariffs are illegal. They did not provide a border adjustment tax that I was just talking about in 2017 when they had the opportunity because Congress doesn't support it. And the courts are finding that the president doesn't have the authority. So it is a massive risk for the administration that I suspect will probably come to a conclusion in September, October after the Supreme Court hears the case.
At the same time, Henrietta, hasn't popular opinion changed? I mean, it has changed, at least in markets, with the idea that suddenly people who hated tariffs at the beginning of the year are saying, look, maybe it's a necessary evil. And in fact, it's going to bring billions and billions of dollars into the coffers of the U.S. Treasury at a time where it really needs the money to offset some of the spending that's been going on.
Yeah, popular opinion is very different than the markets. And I would really, I think you're nailing something really important here. The question that we're all going to pivot to here is that the market has digested the fact that these tariffs are going on and they've acclimated. That's what the markets do. Consumers hate the tariffs. Make no mistake about it. 89% in a recent study from Gallup found that they were concerned about higher prices, concerned about consumption. Now think about what happens in the next election. This is the largest tax increase on American households that has ever been put into effect. Again, $2,500. And it's extraordinarily regressive, right? Like 44% hikes to footwear and textiles, things that you need to buy for back to school or what have you. The next president gets the opportunity to come around and take these all off if the courts even allow them to stay on. So it's a pretty ripe campaign slogan for anybody willing to lift it up.
Do you see any evidence whatsoever that someone's willing to make that campaign?
Not yet. I think it's really early, but as these tariffs become more and more digested by the markets and prices start to increase, which we're always expecting in the next couple weeks, which is now very tiresome to say, but you're starting to see those price hikes, especially on low cost goods. So seizing on it as a campaign talking point, it's an excellent stimulus. Take the tariffs off, families get $2,500. It's right there.
The effort at the moment is incomplete, as you know. The two big missing pieces, Mexico and Canada. Henrietta, what's happened to Mexico and Canada, and where do you think this one lands?
This is the biggest one. And my understanding is that about 60% of goods coming across the border between the U.S., Canada, and Mexico are going to see higher rates on August 1st. And we need to not miss the sectoral tariffs here as well. Lumber just got increased with their countervailing duties over the weekend. I mean, these are real tariffs on our largest trading partners. I'm thinking that we're probably more likely to move with the USMCA on the original schedule, which means, comments, business community, interplay in the October, continuing this through January with another round of negotiations, and then getting some sort of resolution next summer. I think we're playing a really long game with Canada and Mexico, and that's going to keep tariffs on. And they're very exposed to the threat potentially for Mexico of transshipping tariffs, which you pointed out earlier in the show. Those tariff rates so far are on at 40% on the Philippines, on Indonesia, on Vietnam. If Mexico's in the same basket, why would you, give them an exclusion? So I think that's really something to watch. I think it's going to be a while.
When you put all this together, Henrietta, it seems like the market's moved on. It's not the worst case scenario, so it's a really good scenario. That's at least what the pricing seems to be suggesting. What are companies saying to you? How are they managing through this? How many of them are just ignoring it and saying whoever's going to come on next in terms of being president is just going to take tariffs off or adjust policy in a different way?
They're temperature setting right now. There's no consensus as yet. If I talk to Republicans, they'll say, nobody took off the Section 301 tariffs against China. Why do you think they'd take off the IEEPA tariffs? Number one, they're totally different animals. One was targeted specifically at China, which the United States generally believes is a sort of an enemy and a risk and something that needs to be controlled. And the populace of the United States is behind that. I believe last I checked, 83% of Americans view China as the number one or some sort of a negative, nefarious actor on the U.S. economy. So there's support for that. These are global tariffs. I don't know anybody that wants to tariff the EU or has a hard time with Italy and France and wants their wine to be more expensive. So what the corporations are trying to do right now is understand what does come next. The sectoral tariffs, therefore, are the most important. If you're going to have a 232 tariff on, that's going to stay. We've seen that across many administrations, and it can be increased, and it's not subject to court oversight. So the 232 tariffs in those sectors need to start planning for long-term tariffs. On the IEEPA front, the everyday stuff that's coming across, there's no reason to expect continuity there.
No one should have a problem with Italy. Let's be clear about that. Henrietta, thank you. Henrietta Treyz of Veda Partners.
Bold words.
Neutral.
What a shocking
words
from Jonathan Ferro.
Up next on the programme, look what's here. The English Premier League trophies arrived. The CEO, Richard Masters, joins us next. Plus, Danny Berger with your Morning Movers. Live from New York, this is Bloomberg. 5 days of gains on the S&P 500, 5 consecutive all-time highs. We're looking for day 6. Equity futures positive by 0.1%. On the Nasdaq 100 up by 0.3. With 2 hours until the cash open. With your Morning Movers, here's Danny Berger. Hey, Danny.
Hey, John. As a result of the deal with the U.S. and EU, we're seeing American energy companies outperform this morning. A lot of LNG producers like EQT, like Venture Global, up as much as 6.5%. $750 billion is the amount that the EU will be spending as part of this deal on U.S. energy. The EU saying it will help relieve some of their reliance on Russian energy. At the same time, we're also seeing Tesla, those shares rallying in the pre-market this morning, reaching a $16.5 billion agreement with Samsung to build next-generation AI chips for the car maker. It'll be at its Texas foundry. Elon Musk saying that that's really just the tip of the iceberg. The actual amount that they're going to be producing is likely to be much more, and he said it's hard to overstate how consequential it will be. Finally, wrapping things up with some sell-side action for you. Nike getting a boost from JPMorgan this morning, moving the stock to overweight from neutral. A $93 price target on it. It's at $79 in the pre-market this morning, up 3.8%. JPMorgan saying that it's seen some of its inventory clear out, less discounting is to come, and its product innovation is starting to finally pick up. John.
Danny, thank you. With the latest, more from Danny in the next hour. On our radar this morning, our top story, the US and EU reaching a trade deal over the weekend. The EU facing 15% tariffs on most of its exports, including autos. The rate's set to take effect on President Trump's August 1st trade deadline.
Yeah, one of the most difficult things is understanding messaging from reality, because what you're hearing from European Trade Commissioner this morning is there still is room for negotiation and potentially could get a zero for zero type of tariff agreement, more potential items put on that. That said, it does seem like a win for the United States, and that's certainly reflected in the currency market with the euro weakening today versus the dollar. Without a doubt. But there are two questions that remain unanswered. The pushback we will get from European member states in the weeks to come. One, two, how binding these investments and purchase agreements actually are. And those questions apply not just to the Europeans, but to the Japanese as well. What are these agreements? I think that you can take that a step further and say, what are the parameters for some of these investment funds that we've heard now from Japan, the $500 billion invested in the U.S., now the $600 billion promised by the European Union. What do those look like? What is that fund? We don't really have a lot of details around that. These are the talks in Scotland over the weekend. These are the talks taking place right now in Stockholm, Sweden. The U.S. and China kicking off a fresh round of trade talks today. Officials looking to extend their tariff agreement beyond a mid-August deadline. Most people in this market believe we will get a 90-day extension. Yeah, so the key question is, what are the parameters of that extension? What are the chips on the table, so to speak? This comes alongside questions around when Xi Jinping and Donald Trump are going to meet, and then questions about what the long-term relationship looks like, right? Ultimately, what are we working toward at a time where we haven't really established what we want the relationship to be, and whether there is a real national security threat when it comes to certain aspects of this, or whether there's not. You've given a nod to our next story twice now. Exactly. Sectoral tariffs. What happens with chips? What happens with pharma as well, and a whole host of other sectors? Yeah, and this is the reason why people are watching the investigation into the semiconductor space so closely, because ultimately that is going to set the tone for what type of national security the risk is coming from China. And it also sets the tone for a lot of the big earnings that we get this week, given the fact that right now we're looking at some of the biggest tech companies that could be affected by some of these curbs. That right there is the latest on the trade front. Let's turn to sports. Deep breath. Can calm down now. The world's most watched football league making its way across the Atlantic. The English Premier League is playing 6 matches for sold-out crowds in New Jersey, Chicago and Atlanta this summer. The series kicking off this past weekend with Manchester United beating West Ham. Joining us now, I'm very pleased to say, the CEO of the English Premier League, Richard Masters. Richard, good morning.
Good morning. Thank you for having me.
Welcome to the studio here in New York. It's good to see you, sir. Let's just talk about your involvement in the sport. I think it's almost 20 years of direct involvement with the Premier League. Are you surprised by the amount of growth we've seen, not in the UK, forget all of that, the amount of growth we've seen in America?
Yep, 20 years next January at the Premier League, 7 years as CEO in December. Watch the Premier League get bigger and bigger and bigger. And out here in the US, we've got a fantastic broadcast relationship with NBC. We've opened offices here in New York. We're committed to growing the game. About 30% of the US population are interested in soccer or football, and about 2/3 of those follow the Premier League, and that's a brilliant foundation from which to grow. That's the reason we're out here with 6 of our teams playing matches to give our fans a taste of the Premier League.
As a Brit in New York, I can tell you the experience of NBC is amazing. I get to wake up on a Saturday morning, on a Sunday, and I get to watch absolutely everything. That's not the experience in the UK with Sky. It's a very different experience. You only get to watch so much. Why do we get to see so much more through NBC than maybe fans in the UK get to see at home?
Well, in the UK, the matches between 2 and 5 o'clock on a Saturday afternoon, which is the traditional time to go and watch football in the country, aren't broadcast. So it's not just the Premier League, the EFL as well aren't broadcast. And that's part of the decision we've made. It's a long-term commitment to what's called Article 48. But anywhere else outside of the UK, it's all 380 games throughout the season you can watch. Of course, here in the US, as you say, there are millions of people getting up on a Saturday and Sunday morning, watching their favourite team, and you can sit there from 7 a.m. till lunchtime, watch the entire thing if you want to. And that's a brilliant thing for us.
Does it kind of hurt your soul to say soccer instead of football?
Not at all. I think they're interchangeable. When I grew up in the Midlands, I watched Soccer Sunday on Star Soccer, rather, on a Sunday lunchtime. So it's interchangeable.
Yeah, at this point, though, does it dilute the player's ability to really commit to not only a team, but a season if they're playing at all times, in all places, and their bodies have to be exhausted at a certain point, no?
That's true. I mean, there is a strata of players at the top of the game who are playing a lot. And it's a big issue within the game. The Premier League, obviously, since '94 has been 20 clubs, 380 games, August to May. But we've seen the gradual expansion of European competitions and now global competitions as well. Next summer, the US will host the World Cup. It's the first time 48 teams. And of course, in the last summer, we've seen the Club World Cup, a brand new competition put into the calendar. And I think that from my perspective, not just as CEO of the Premier League, but also my other role as chair of the World Leagues Association, which is about representing domestic leagues around the world, there has to be a big conversation now about how you balance this out properly and make sure that players are looked after and that these competitions are additive and not subtractive from the competitions they bump into.
Well, let's have that conversation right now. I can speak as a fan. I hate it. I don't want to see an expanded FIFA Club World Cup. In fact, for most fans of the English Premier League, we get annoyed whenever there's an international break. We don't want to see more tournaments. What we loved was just the cadence of every 2 years, you had a major tournament, the Euros, the World Cup, the Euros, the World Cup. Why have we gotten away from that? And what's your message to FIFA, to UEFA? As in the minds of many fans, they just seem to be chasing money at the expense of the game and maybe the players' health.
Well, the message is talk. There is actually strong dialogue between domestic leagues in Europe and UEFA about competitions. And that's a coalition of stakeholders, clubs, leagues, players as well, talking about it. That dialogue doesn't happen at the top of the game, and it should do. So that's the key message. Sit down and talk to the leagues, talk to all the stakeholders, and find a way through all of this, because it has a limit. And I think we've gone past it. We've gone past saturation point. My job, obviously, is to look after the Premier League. And we're going great guns, thank you very much. And I want the purity of that competition to remain. I want people to be able to enjoy their football, because I want the best players on the pitch all the time in the Premier League and not worrying about how to balance everything out.
Let's talk about the purity of the game. It's a polarising topic and very controversial, as you know. Manchester City in this number 115, the number of charges for alleged breaches of financial regulations. What can you share with us this morning about where things stand?
Nothing is the honest truth. The case was heard last year, and we wait for the decision to be made. We can't hurry the people whose job it is to make that decision, and it will happen when it happens. And I don't know when it's going to be. We'll find out with everybody else.
What's your sense of why it's taking so long?
I don't know, and it's difficult for me to speculate. I'm sorry.
It's just difficult for a lot of people in the game who follow the game to see how quickly things concluded with a club like Everton and how long it's taking with a club like Manchester City. And some people can't help but conclude that maybe different clubs are being treated differently because of the status they have in the Premier League.
Yeah, well, I do understand the frustration and share some of those, but in the end, this process is very different. These allegations are very different.
What makes it different?
They just said the charges themselves and the number of them. But I can't really get into it. I really can't talk about it.
You can't get into the details, but do you think it's hurting the reputation of the league?
Well, at the centre of this is a football competition, and I think people want to basically watch the football. That's the main event. And when you get dragged into whatever it may be, financial affairs, I think people think that maybe there's something going wrong here. I do accept all of that. But the competition remains strong, the economics of the Premier League remain strong. And fundamentally, as long as we can put the best players on the pitch and give people a fantastic competition, I think we can get through this period.
I've been an outsider, and I've been studying the rules of the game and the sustainability rule that kind of led to this investigation into Man City and this idea that a club has to bring in and just spend the same amount of money that it brings in. Do you think that that rule has become outdated or unenforceable in any kind of real-time way?
So if you're talking about the financial regulations within football, our clubs are all really subject to two sets of regulations. Our own, the profitability and sustainability rules, and also UEFA's rules. So they're looking at two sets of financial rules to comply with. And essentially, in England, our rules are there. It's a spending rule, really, about profitability. So there is the ability to invest. And that's what we want our clubs to do. We've got a fantastic set of owners that invest in stadiums, in fan experience, and players on the pitch. And that's what we want. We have, as I said, a great set of owners that want to invest. And so there has to be a limit, ultimately, to ensure that we've got a competitive league, which we do have. So I think when owners look at investing in the Premier League, they can see that you can aspire to do better in the league. We're now seeing more clubs qualifying for European competition. Our clubs are incredibly successful in Europe. And that's all down to investment. So there has to be a limit, ultimately, on what you can spend. Clubs have all signed up to these rules, and we are enforcing them.
Well, how much does the Saudi League really kind of, I don't know, skew the financials of this in a way that creates a sort of complicated dynamic?
Well, the Saudi League is an investment phase. Saudi League's been around for many decades. And now we're seeing local investment into that, and they're becoming very active in the marketplace. Sometimes that's good for Premier League clubs. Sometimes they take players that Premier League clubs want to sign. It's just a new dynamic. And we have to observe it, and we have to cope with it.
Richard, you've been generous with your time. We appreciate it. Thanks for dropping by.
Thanks for having me.
Thank you very much for being here. Richard Masters there, the English Premier League CEO. Just getting some live pictures out of Turnberry, Scotland. The President of the United States is welcoming Sir Keir Starmer following a big agreement with the Europeans over the weekend. And I imagine the British Prime Minister's feeling a whole lot better about the deal that he got a few months back.
Yeah, it seems like it's an unheard of 10%, given the fact that 15% is the new floor. And it does raise the question about sort of Brexit and what that did for the European Union versus Britain and the deal that they were able to get. I wonder what the tenor of that discussion is going to be at a time where they have a much easier sort of conversation to have.
What's Starmer's golf game like? Do we know? I don't think we know. I think he's a football guy. Arsenal fan, isn't he?
He is.
Big Arsenal fan.
Does he play golf?
I don't know that.
I don't know.
Try and figure that out.
I guess that we'll find out today.
We'll get some comments from those two throughout this morning. Any big headlines, we'll bring them to you. Let's get you an update on stories elsewhere this morning. With your Bloomberg Brief, here's Yahira. Hey, Yahira.
Hi, John. Israel has resumed limited humanitarian aid to Gaza, easing restrictions over the weekend after mounting global outcry. The Israeli military paused some operations to allow UN convoys in and restored power to a water desalination plant. As you saw just earlier, UK Prime Minister Keir Starmer and President Trump are meeting today in Turnberry, Scotland, and Gaza is on the agenda. And following on your football conversation, England defeated Spain 3-1 in penalty kicks to win its second consecutive UEFA Women's Euro final. Sunday was a rematch of the 2023 Women's World Cup, where Spain came out on top 1-0. 27-year-old Chloe Kelly scored the decisive goal for England. And it was a fantastic weekend at the movies this weekend. Disney's The Fantastic Four: First Steps opened at #1 in North America with $118 million in ticket sales. The Marvel movie beat out DC Studios' Superman, which has grossed nearly $290 million since opening earlier this month. Meanwhile, Universal's Jurassic World Rebirth came in third place. That's your Bloomberg Brief, John.
Yahira, thank you. Appreciate it. Up next on the programme, building pressure for a rate cut.
It looks like it's about $3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
Yeah, I haven't heard that from anybody at the Fed.
Up next on the programme, Ed Al-Hussainy of Columbia Threadneedle, live from New York City. You're watching Bloomberg TV. Happening right now in Turnberry, Scotland, the President of the United States, Donald Trump, alongside the British Prime Minister, Sir Keir Starmer. Odd situation here that it's actually the President welcoming the British Prime Minister in Scotland at his golf course.
Well, and it comes at a time where essentially every European leader is lining up to say, thank you, can I have another? And right now, Keir Starmer is saying, thank you for only 10%. What we're hearing from President Trump is we're in great shape with the United Kingdom, and goes on to cheer that relationship at the same time that they now have a deal with the European Union.
We want to make Starmer happy. Now, Sir Keir Starmer is having a very difficult time of it in the UK across several dimensions, immigration, the broader economy. But on this one, on this specific issue, I think he can claim a win relative to what we've seen with the Europeans and with Japan.
If you remember, all the way back when we got that agreement, people were talking about 10%'s the floor. Now it's not the floor. They actually did get special status. 15% is the floor. And now the UK is looking even more special at this moment when they're being welcomed to their own country at a golf course.
Up to speed on this?
Not really, but okay, yes.
That's the situation taking place in Scotland right now. Those two should hold some kind of a gathering a little bit later in the hour, in the next hour, so we'll bring you some headlines if we get them. Equity futures on the S&P 500 positive by 1/10%, just about hanging in there. On the Nasdaq up by 0.3. Huge week coming up for earnings, for data, and for the Federal Reserve. Under surveillance this morning, building pressure for a rate cut.
We're just taking a look at what's happening. It's a tough construction job. It looks like it's about 3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
Yeah, I haven't heard that from anybody at the Fed. You're including the Martin renovation. You just added in a third building is what that is. That's a third building.
Well, no, but it's a building that's being built.
No, it was built 5 years ago.
It's part of the overall work.
So, it's not new.
Well, I'd love him to lower interest rates. But other than that, what can I tell you?
It was like an episode of The Office just last week over at the Federal Reserve. Season 2 coming up a little bit later this week on Wednesday. Expected to hold rates steady this week despite rising pressure from the White House and President Donald Trump. Al-Hussainy of Columbia Threadneedle writing, I think we should have better odds that the unemployment rate remains stable and inflation uncertainty delays Fed cuts to 2026. Ed joins us now for more. Ed, welcome to the programme, sir. That delay to Federal Reserve interest rate cuts, let's work through that together. A lot of people think that by the time we get to September, they'll be reducing interest rates. If you think they're going to be wrong, essentially you're making the case that in the next few months, we'll have some very different looking data. What do you expect to see?
I think roughly the case rests on three key pillars. One is that we build confidence that the inflation story is going to be stable. We're still heading towards 2% in the short to medium term. The second is that the unemployment starts to pick up and risks to unemployment start to rise. And then the third story is we're really continuing the process we began last year, normalizing rates in line with an economy that's normalizing in the background. And I think on all three fronts, the room is continuing to get smaller for them to pull the trigger on these cuts in September.
And if that's the case, what happens if they do cut rates in September? Let's say they cut rates twice this year, as markets are expecting. Does that lead to yields rising at the long end, inflation expectations over a longer term creeping higher?
Yeah, I mean, that's the trickiest story. In many ways, if they ease into an economy that's perhaps stable or even accelerating, then the odds that those long end rates rise, I think, increase significantly. And we're going to replay what we saw in the fourth quarter of 2024. If they're cutting and the economy is getting weaker in the background, then, of course, I think the story is quite different and long end rates can continue to perform.
What do we need to see to really answer that question? Are we just in the dark right now, just trying to fish and come out with proclamations?
Yeah, I mean, for me, the labor market is absolutely core to this. And in many ways, labor market data has been more difficult to read because the underlying supply side story is changing so rapidly with immigration. And so focusing on something quite core like the unemployment rate is going to be key. And so if the unemployment rate is stable for this in the second half of the year, the odds that those cuts are timed well, I think, continue to diminish. That it makes a lot more sense to cut next year if the unemployment rate is stable.
And in the statement, they refer to it as solid. Do you think they can repeat that statement this week?
I think absolutely. So far, in the first half of the year, the labor market's been characterized by incredible stability. The unemployment rate remains right around, 4.1%. Now, last year, unemployment was deteriorating. The labor market was slowing much more rapidly. We saw that increase in the unemployment rate in the course of the year. And they pulled the trigger on 100 basis point cuts to stabilize that story. That catalyst isn't with us this year. And so what you're doing, if you're cutting rates, is you're looking ahead and making the case that, look, the labor market is okay now, but the risks are rising that it's going to slow. And, so far this year, the data really hasn't validated that yet.
Governor Waller says it's a labour market on the edge. Lisa's been asking all morning, how much dissent will we actually see on Wednesday? There's two governors in mind. Do you think we could see some more?
I think it'll be difficult. I think Governor Waller has telegraphed his view very effectively. I think it's going to be in line with some of the dissents we saw back in 2019. And, you know, there is a case to be made there, but I think it's really the minority at this stage making that case.
At this point, when you look forward at the politicization of the Federal Reserve, do you think it's noise for markets, or do you think that it will become much more front and center on Wednesday in a way that could influence how the markets respond?
Well, my sense is really it's a story for next year when that new Fed chair takes control of the committee. If the bias is to ease rates when the economy remains strong, or again, if the economy is accelerating next year, that's going to be deeply problematic for markets. And again, that's something that's a critical risk to the long end of the curve. If you're easing rates into a strong economy, that long end premium, the inflation premium, is likely to go up. And again, we're going to see something that resembles the fourth quarter of last year. For this year, I think despite all the pressure that's on the Fed, and despite the fact that we might see some dissents over the course of the next couple of meetings, I think it really isn't likely to filter into markets more than it has so far, which I think is really de minimis.
Just before you go, just on the long end of the curve, can we just finish on tariffs? The amount of revenue that's going to be coming into the Treasury from those tariffs and what it might mean for the shape of this yield curve.
Yeah, the way I look at it is tariffs are taxes. To the extent that we're increasing tariff revenue, we're increasing the tax burden on the economy. To the extent that that slows the economy, it strengthens the case for cuts next year. It means fiscal policy is adding less to the growth story over the coming quarters. In my mind, fiscal policy right now is roughly neutral. By next year, it might be marginally positive as some of the spending is front-loaded ahead of midterms. But the more tariff revenue we raise, the less that effect is. And so in some ways, higher tariff revenue makes it easier for the Fed to approach the tax cut story. And I think, again, this is more a story for next year rather than this year.
Interesting. Ed, thank you, sir. Ed Al-Hussainy there of Columbia Threadneedle. Higher tariff revenue may be bolstering the case for cuts next year, but higher tariffs bolstering the case for them to wait this year. Got all that?
No, but your point is well taken, which is if people talked about yields going up on the fear of a deepening deficit in the United States, well, more revenues from tariffs should offset that deficit story and actually give more of a bullish case to yields coming in, even though in the short term they're inflationary. We'll keep parsing through this.
Tough to follow, right?
Well, the whole year has been.
The 10-year at the moment, not doing much, just about unchanged, 439 on 10s. Up next, Yoder of JPMorgan, Scott Devitt of Wedbush, Steve Ricchiuto of Mizuho, Troy Gayeski of FS Investments.
We're just observing, obviously, a pretty frothy set of markets right now.
It is about tech, and I think it's something to keep an eye on.
I do think there's a statement of pause here, right? We have to see these earnings come through.
I think we could get a little bit of rockiness.
I think the rally can stay for at least through the summer.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. The third hour of Bloomberg Surveillance starts right now, looking for a sixth consecutive day of gains on the S&P 500. Futures this morning just about positive. Here are your scores, up by 0.1% on the S&P, on the Nasdaq up by 0.3. Later this week, Wednesday, Thursday, 4 tech monsters, Meta, Microsoft, Apple and Amazon. If you want the earnings, if you want the data and the Federal Reserve, this. Payrolls on Friday, the Fed decision, just 2 days away.
Yeah, the moment of truth this week, and I keep repeating what Julian Emanuel said, because truly you cannot overstate just how important this week is going to be. We're heading into the second half of the year at a time where we have more certainty, and companies have to give visibility. If they don't, or if they give some sort of sense that maybe they don't have a sense of visibility, watch that punishment in terms of the share price, because we've seen that in a couple of fronts.
That's the earnings. Do you want some visibility on the data?
I would love some.
Okay, median estimate in our survey for Friday, 109. Here's the range. 170 is the high, 0 is the low. Stephen Stanley, Santander, thinks we're just going to be 0 for jobs.
And I believe he's joining us tomorrow so he can give us a fuller explanation of exactly why and whether that's negative or whether that's just sort of the supply-demand dynamic coming into even balance. The real question is going to be the unemployment rate. We've been hearing that time and time and again from a number of guests this morning and through the past couple of weeks, simply because we need some real measure to compare one thing to another, given how much the demographics could be shifting with immigration.
Governor Waller's going into that meeting, which starts tomorrow, making the case for a rate cut, pointing to the labour market and saying we're on the edge. At the same time, the FOMC is going around saying the labour market's solid. How are those two things going to work this coming Wednesday?
With a lot of political disagreement and a lot of tweets and truth socials, and that's going to be a real question. And sort of how will the market look through that? Because right now, the drama has made for really good TV. And I swear, I do think that Donald Trump and Jerome Powell should have a television show together because that was really high drama. But besides that, you're not seeing the drama bleed into markets. I do wonder how you understand a labor market that's solid with entry-level jobs that really are just not getting filled. People who are graduating from college have one of the lowest hiring rates in a very long time. I don't know how you square these things.
Would you like to see a repeat of last week, this Wednesday? Just have that news conference, two of them in there.
From like a pure market perspective, no. But from a drama perspective, I mean, we keep repeating it from last week because it is that good. So, it was pretty impressive TV.
I understand there's some legal proceedings ongoing to try and open up the Federal Reserve meeting this coming Wednesday and make it public. Do you have any idea how boring that would be? The news conference is boring enough.
I was thinking the same thing.
Do you have any idea how boring watching that would be for hours on end?
I think that it's more exciting to think that there's some sort of collusion and an exciting cabal that gets together to say, whoa, what should we say to Donald Trump? And instead it's, people parsing through the beige book. You really want to see that for 2 hours?
I don't need that live on a Tuesday and a Wednesday. That's for sure. Maybe one of the options, sort of on demand.
Okay.
In this world, on demand.
Yeah. So how much would you
on
pay
demand.
for that? Bloomberg on demand?
Bloomberg on demand.
$2.
I'd pay serious money for Bloomberg on demand.
Oh, of course you would.
Obviously.
But what about live streaming?
Live streaming that? I wouldn't.
Meeting?
No.
I think a lot of people would. I think that it would be really cool.
Make it happen.
Okay. I'll try.
Futures right now in the S&P. Positive by 1/10%. Coming up this hour, Yoder of JPMorgan as equities add to a record-breaking rally. Scott Devitt of Wedbush with Mag 7 earnings on deck. Steve Ricchiuto, about 25 minutes away, of Mizuho, ahead of a busy week of economic data. We begin this hour with our top story, the race to strike trade deals with the United States. Joining us now is Bloomberg's Tyler Kendall. Tyler, making a deal with the EU. Who's next?
Yeah, hey, John. Well, there's still a long list of trading partners that need to announce a trade framework with the U.S. We know that some of those trading partners that have long been prioritized in these talks, those countries that are geographically close to China, such as South Korea or India, perhaps, are still waiting to clinch a deal. In fact, the USTR, Jamison Greer, in an interview earlier this morning, said that they were still working towards trying to get India done by that August 1st deadline, but still big sticking points remain, particularly when it comes to market access for U.S. agricultural goods. And then we have to keep in mind that some of these countries that have been on totally separate negotiating tracks, like Mexico and Canada, for example, still haven't reached a deal either. Now, those tariffs were implemented back in February on concerns about the border and fentanyl. They were not part of the so-called reciprocal tariffs on Liberation Day, yet they have still found themselves in line with this August 1st deadline. Then, of course, lastly is China, which is on a completely separate third track here. We know that those negotiations are kicking off the third round for negotiators later today in Stockholm.
Tyler Kendall with the latest. Tyler, thank you. Looking for those trade talks in Stockholm to conclude with maybe a 90-day extension to the conversation. Then you get to Friday. If you're not in negotiations right now, you're just getting a letter, aren't you, from the president, and it's got a number on it.
All I can say is that how many letters have you gotten from a lot of analysts on Wall Street saying deadline, in quotes? I mean, how many people are treating these deadlines like actual deadlines? Are we really worried about the penguins? I mean, at a certain point, which are the true trade partners that are going to matter with the United States that are going to have non-negotiable letter type levels?
Everything's negotiable to an extent.
Exactly.
Obviously. But it feels like once you've secured a deal with Japan, with the EU, once you've basically concluded you're going to kick the can with China for 90 days, this is kind of it for everybody else. At least that's the sense I've got of things.
I would agree, unless there's some sort of strategic significance with respect to transshipments from China, unless there's some kind of real reliance on a specific nation, it will be over, which is the reason why this market's moving on.
With two exceptions, Mexico, Canada, which could take another 18 months?
It's going to be fun. I think that's what this market's
There's a lot of fun in store. Here's the view on Wall Street. Yoder of JPMorgan Global Wealth Management writing, investors have turned risk on. Fears over trade and policy setbacks are fading as investors focus on strong fundamentals. Abby joins us now for more. Abby, good morning.
Good morning.
Question we've been asking all morning. We know what the tariffs are for certain nations. Do we fully understand the consequences?
Well, I mean, I think on a relative basis, yes. Like if we're thinking about where we were in April versus where we are today, and you're thinking about, from a corporate standpoint, when we were going through 1Q earnings and you had all of these different scenarios and these worst case scenarios in terms of what kind of hit they were going to take from tariffs, like that left tail risk has certainly moved, more to the right. So I think that's in particular very good for the stock market, generally speaking.
You've said strong fundamentals. Are you confident the worst of the data is behind us and not in front of us?
No, and I think the market knows that. I think the market knows that we're going to see this. You see it in consensus estimates, right? You're like on your Bloomberg terminal in terms of what happens in terms of economic growth as we head through the rest of the year. That's relatively well understood. What the market is thinking and looking at is, okay, this is a blip, right? We have this second half weakness, but then we go into 2026 where we have the reconciliation bill, which is really like a cash boost in terms of thinking about corporates. And we've got like pretty solid earnings so far, right? From a profit margin perspective, we're really hanging in there. We're still above the long-term average in terms of profit margin. So in terms of company performance, yes, you might see a slowdown in economic growth, but you're still seeing really like resilient results from companies.
So why isn't your current base case higher for the S&P 500? It's currently at a range of 5,900 to 6,300. We're surpassing that. We're almost at 6,400.
Yeah, and so, we do have a bull case, and that is 7,000 to 7,100, and it feels like we're inching closer to that, right? Like when you put all of these pieces together, again, you take out that left tail risk as it relates to Liberation Day levels. You have this really strong, we're in the middle of 2Q earnings. Coming into the season, expectations were for 4 to 5% growth. We're already close to 7% growth with what's reported. We obviously have a 30% of market cap reporting this week, but it's been really solid. So, as we get these trade deals and we think about, the scenario analysis, it does feel like we're leaning closer to that bull case.
It seems like that's what we're hearing from Mike Wilson over at Morgan Stanley. John Stoltzfus over at Oppenheimer came out and raised his expectation for the S&P year-end target. I just wonder what we could hear this week that would give you that confidence. Is it some sort of projection into 2026, given that that's when the strength is expected to resume?
I don't know if it's necessarily a project. We're not anticipating, because you don't typically have companies do that in the middle of the year, but it does seem like there's more of a focus on 2026 right now than there is historically when you're in July and August. But I think, if you have mega cap companies that are committing more capital to their AI spend, and this is across sector, right? Like we're thinking about it not just within tech. I think that in and of itself lends it to like more clarity on what 2026 could look like, right? Because if more companies are spending on this productive capacity in terms of technology, that bodes well in terms of 2026.
Do we need the Fed to cut?
I'm surprised that you're starting to see more of this cyclical rebound in terms of price performance without that. That felt like it was necessary in terms of getting that, because manufacturing's been basically in a recession for 3 years. What gets that rest of the market, that part of the market working? And I mean, think about it. You have these commitments to spend in terms of, across the board in terms of sectors. Like let's use pharmaceuticals, for example, $300 billion in commitments to reshore, to rebuild manufacturing, which in and of itself could create more of a tailwind for industrial capacity despite higher rates.
You've talked about how forgiving the investors are going to be of potentially weak data in front of us. And I just wonder how relevant it will be if the Fed isn't cutting interest rates. We just heard from a guest 15 minutes ago said no cuts for 25. We've heard that from other banks as well, from Morgan Stanley, from Bank of America. Is that relevant to your bullish view on the equity market?
Yeah, so we do in our base case have 2 cuts this year, and another 2 through the first half of next year. So we do have an easing bias, which in and of itself is very important when we're thinking about valuations for the S&P 500, right? You have the combination of strength and earnings growth with an easing bias, right? I don't think anyone's debating right now whether or not the Fed's going to hike. I don't think that's really on the radar. It's just a matter of when they cut that can really, I think, sustain valuations from here.
What's more important for you this week, just to sum it all together? The Fed meeting, the earnings, or the economic data?
I think I'm an equity strategist, so earnings are going to be very important. Obviously, that's going to be more idiosyncratic depending on what industry then. And then I think, I really do think the employment data, obviously, that's the main focus right now. And it was interesting when you were talking before, you were saying like, oh, but the labor market's solid, but it's weakening at the, those two things are happening, right? Like that the labor market remains solid, but you are seeing some weakening at the margin. So thinking about what happens with labor market data this week, but, unemployment claims have been pretty tame over the past couple of
What's
weeks.
your pick this week?
I would pick earnings, actually.
Would you?
Yeah, because I think that employment...
So we're on the same team.
We're on the same team, yeah. I think
because you're sick of the Fed chat or because it's more important?
Well, yes.
Yeah, you guys didn't sound excited about the Fed.
Well, I just feel like the market isn't that excited about it, and we already know it's going to happen. I just feel like the earnings really is a different story. It's the AI sort of secular change that is underpinning the strength that so many people have gotten behind. And that's pretty exciting to me right now.
Apple front and center for me.
Yeah, exactly.
That company's in a tough spot right now. Leadership is arguably as well, in a way they haven't been for a long time.
They've been on the back foot when it comes to AI. They've got this situation with China. And Tim Cook, no longer diplomat in chief. So then all of a sudden you have a real problem when it comes to relationships with the president.
Gents of Wang, the man in charge, apparently.
Yeah, exactly.
A foreign policy as well on certain issues too.
Evidently, what's the difference?
Just to finish, Abby, on the international backdrop, this preference for international over the US over the past several months, in the midst of all this trade volatility, what is the argument now for superior returns in a place like Europe?
Well, so I think if we focus again, if we're thinking about 2026 rather than 2025, the bull case is that for Europe versus the US is that you're starting to see a convergence in that growth rate, right? Like there's been a really wide, divergence in terms of earnings growth in the US versus Europe. But now you have this domestic story as it relates to fiscal spend, mostly stemming from Germany, that could really propel, we're not calling for that gap to close, but if you see it, shrink, that in and of itself could uphold valuations and create more of a tendency for investors to.
They're going to borrow in the debt market to fund US defense players now, based on the agreement over the weekend.
Let's see. And frankly, everyone wants to go to their debt market because it's going to be the new reserve currency, right?
Apparently.
Yeah, that's what we hear.
Sure. Abby, thank you. Appreciate it. Thank you very much. Abby Yoder there, JPMorgan Global Wealth Management. I don't think we've seen the end of the fallout from the weekend from the Europeans. There's going to be pushback. The Spanish government joined us in Washington, D.C. a few months ago and referred to the Chinese as allies. Do you think they're going to be willing to get on board to accept a 15% tariff and then go after Chinese overcapacity? I certainly didn't get that sense, did you?
No, and we've already heard some dissent coming from France in particular and a couple of different ministers there. I do wonder how much this does threaten some of the unity of the European Union and really raise some of the issues that have blocked that region from having the sort of economic power that they should based on some of their productive capacity.
Euro dollar this morning negative by 0.75%, 116.55. Let's get you an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahira. Hey, Yahira.
Hi, John. President Donald Trump speaking in Turnberry, Scotland minutes ago alongside UK Prime Minister Keir Starmer. Trump telling reporters, quote, "We're in a great shape with the UK and we want to make Starmer happy," potentially talking about trade there. The president also said he discussed Gaza with Starmer at their bilateral meeting and said he won't take a position on a Palestinian state. Meanwhile, U.S. and Chinese officials are meeting in Sweden today to extend their trade truce beyond its August 12th deadline. It will be the third meeting in less than 3 months between Treasury Secretary Scott Bessent and Chinese Vice Premier He Lifeng. A breakthrough during these talks could set the stage for a meeting between Trump and Xi Jinping later this year. And the heat is on here. More than 132 million people across the central and eastern U.S. are facing blistering temperatures this week, with rising humidity making it feel even worse and putting a strain on the energy grid. This has been the third hottest July on record. That's your Bloomberg Brief. John?
Yahira, appreciate it. More from Yahira in about 30 minutes. Up next, the morning calls, plus Scott Devitt of Wedbush with Mag 7 earnings on deck. That conversation up next.
We've reached a deal. I think you were saying this is probably the biggest deal ever reached in any capacity.
We have a deal, and it's a big deal. It's a huge deal. It's 15% tariffs across the board, all inclusive.
I think it's the biggest deal ever made. Thank you very much. Congratulations.
We have a deal between the EU and the United States of America over the weekend. That was President Donald Trump and the European Commission President Ursula von der Leyen. This market feeling pretty good about that deal worldwide. Equity futures still positive this morning on the S&P. Mike Wilson and Morgan Stanley leaning more towards our 12-month bull case, 7,200. Drivers are positive, he says. There's many of them. I'll give you a select few. AI adoption, dollar weakness, easy growth comparisons, pent-up demand, and Federal Reserve interest rate cuts.
And he's not alone. We heard that also from John Stoltzfus, upgrading his forecast for the year, expecting another 20% plus return for the S&P 500. And just now, Abby Yoder from JPMorgan Asset Management looking closer to their bull case, which has a 7 in front of it. And this really is, right now, the story on Wall Street.
Crazy how much this story has changed over the past few months. So the bear case became the base case back in April, and now the bull case has become the base case a few months later.
I think we cannot underestimate or can't overestimate how much the deep-seat questions that got overturned with ongoing tech investment superseded some of the concern about global tariff slowdowns that we haven't seen materialize yet in the economic data.
Futures positive by 0.2% on the S&P. That's the price action. Here's some morning calls. First up, Wolfe Research upgrading Texas Instruments to outperform, seeing it as well positioned to benefit from a cyclical recovery. Your second call from Oppenheimer raising its price target on Shopify to 145, citing lower tariff risks. And finally, UBS raising its price target on Amazon to 271, citing extensive investments in e-commerce and cloud services. That stock is up by 0.75%. Let's stick with the Mag 7. Another busy week of earnings coming up with Meta and Microsoft reporting on Wednesday, Apple and Amazon on Thursday. Bloomberg's Ed Ludlow joins us from the West Coast for more. Ed, good morning, sir. 4 big names coming up.
Yeah, good morning. And I think we know it's just all about tariffs. I was listening to your last conversation, and, Apple is in a difficult moment right now, John, and how you framed it in the context of management, really interesting. We know what we're looking for. In the last earnings call, they said that in this current period, tariffs would account for about $900 million of additional costs. But for a company that's forecast to book $62 billion of revenue just on hardware, I'm stripping out services there, that doesn't seem like much. But given the change in the leadership and the shuffling that Tim Cook's done, does Tim Cook, the operator, kind of do what Apple's always done, which is manage the bottom line, find solutions? So the $900 million figure on a tariff cost gives us something to benchmark against, to look at, plus or minus, and see what they'll achieve. But what they're doing in China is really interesting as well, because while globally they are encountering these pecuniary penalties and issues, in China they've done heavy promotion, heavy discounting to get themselves back to growth in that greater China marketplace. So there's a lot to discuss.
Ed, looking forward to the show. At 11 a.m., Bloomberg Technology. Look out for that alongside Caroline Hyde. That's the latest on big tech and Apple specifically. Let's talk about Meta. This from Scott Devitt of Wedbush, reiterating his outperform rating on the company with a 750 price target and writing the following. Investor sentiment has remained encouraging for Meta ahead of Q2 results. The risk reward is attractive, given healthy fundamentals and optionality related to future AI monetization. Scott joins us now for more. Scott, welcome to the program. What a quarter it's been for Meta. And I'm not talking about revenue. I'm talking about hiring. Just some big names and some big money. Do you think investors will continue to reward them for that?
Well, we're going to find out soon. I think top line has held up remarkably well. This company is only a few years removed from the removal of IDFA on Apple devices and a very difficult period for the business, and is now kind of clicking on all cylinders. And now we're entering a period with Meta where the company is very front-footed on spending again versus that year of discipline it experienced in 2022. And so it'll be interesting to see if margins stop expanding because we're now spending into the future of AI, whether the stock performance continues to be as strong as it's been. We're optimistic, but probably a little less optimistic on Meta here than we've been more recently because of that.
Scott, it's fascinating to hear you talk because I remember when spending was considered a really good thing, the more they spent, the better. And then all of a sudden it was a bad thing. People were wondering if maybe some of these hyperscalers and other tech companies were overspending on AI. It seems like we're shifting back to where we used to be, where more spending means more promise, akin to what we heard from Google. Why is that not the case?
Well, as you all just so eloquently described, things change month to month and quarter to quarter. We're 3.5 months removed from Liberation Day, when all the strategists' forecasts were significantly lower than they are now. And I think that the narratives around stocks are very similar. So if Meta hits a period where it isn't exceeding investor expectations for growth, then the spend concerns become more relevant again. I mean, this company, is a company that did spend aggressively on metaverse. A lot of that spend is now being, infused into their AI initiatives. But stories change, So I think right now spend is good. For the companies that I spend most of my time on, which are consumer-facing companies that are spending all the dollars to the semiconductor companies, they're going to have to figure out how to use AI effectively to drive sustainable growth, or what's viewed positively right now, which is the spend, will flip again, sometime in the next 3, 6, 9 months.
Well, you went there.
And that's what I have my eye out on, because nobody's really focused on that for Meta, and it concerns me a little bit.
So Meta being a consumer-facing company, Apple is the primary consumer-facing company. How much do we expect to learn about them in terms of what kind of punishment they're getting on the consumer side, given that they haven't been on the front foot when it comes to AI?
So with Apple, there was a period where the lack of a need to invest in AI was viewed as a good thing because whatever worked could be layered into Apple's services, and the capital efficient business model would move ahead. And so as long as consumers are still buying Apple devices, it didn't really matter. Now there's a view that Apple needs to play aggressively in this area because its historical reliance on Google, for traction that's now under scrutiny by the government. And so with Apple, I think they're going through a bit of a narrative shift, which is difficult to deal with when the multiple on the stock has gone up 3x over the past decade. So, you're paying 30 times earnings for GDP plus growth. And that's the primary problem here, I think, is the multiple, more than that the company is going to be proven to be deficient as we go into AI, because you can already use ChatGPT integrated into Apple, and just like you could use prior generation of search, you can now use AI.
They're in a tough spot,
devices.
Scott, without a doubt. Scott Devitt there of Wedbush. That name is down by almost 15% year to date. Live from New York City this morning. Good morning to you all. Futures positive by 0.2% on the S&P with 60 minutes until the opening bell. With your morning movers, let's cross over to Danny Berger. Hey, Danny.
Hey, John. We're looking at the energy companies continue to rally this morning, specifically the LNG producers. You can see Cheniere, EQT, Venture Global, all of them rallying at least 1.8% after an agreement between the U.S. and EU over those tariffs. A part of it, $750 billion from Europe, will be poured in to U.S. energy. Meanwhile, Tesla also on the move pre-market, an announcement that Samsung would be building chips for them in Texas. I just wanted to point out that Applied Materials is also rallying as part of this story, up 1.8%. Applied Material, their second biggest customer is Samsung. So we're seeing some of the Samsung suppliers rallying on that too. Finally, this morning, we are seeing a rally coming from Norfolk Southern, up 1.8% over the weekend. Bloomberg reporting that likely this week we will hear the finalization of a deal between them and Union Pacific to merge. Union Pacific would be buying Norfolk Southern. I have to say there's been some reporting on the story, at least for the past 2 weeks. So the stock is up 10% so far this month, which maybe is why you aren't seeing a bigger pop. But still, that deal may be to come this week, John.
Danny, appreciate the update. Thank you very much. The opening bell just an hour away and futures are doing okay. Busy week of economic data ahead of us as well, including a Fed decision on Wednesday and payrolls on Friday. Mike McKee has a preview. Morning, Mike.
Good morning, John. Well, we're going to be somewhere in between all sound and fury signifying nothing and the complete template for the rest of the year for Wall Street, because we do have a lot of data. The question is, what will it tell us, and how much will it matter in the end? There is one event to rule them all, and that is, of course, as you mentioned, the Fed meeting on Wednesday. The questions there are, what do they signal about September? Because they're going to leave rates unchanged. We pretty much know that. Do we get the dissents from Waller and from Bowman? And does that matter to people? What does Jay say? Now, that's going to be important. Does the Fed chair have any comment on the president? And certainly then the question is, what is the president's comment on what the Fed does? On the economy, meanwhile, we have a lot of numbers starting tomorrow with the Conference Board confidence numbers. We also get jolts, but that's a little less important these days. How are consumers feeling? We're going to have a sort of a gut check on whether we think people are going to keep spending. Wednesday, we get ADP, totally overshadowed by GDP, but GDP, we're going to have to figure out what it means because of the trade distortions that we saw in the first quarter. How much of a rebound is real? How much of it is just a rebound and a statistical distortion? Thursday is income and spending and PCE. Of course, we'll want to see what happens with spending, but PCE is going to be the question. And right now, analysts are expecting a slight rise in inflation, and we'll look under the hood to see what tariff impacts there are. And then, of course, Friday's the big day. The labor market, jobs day. Do we see a slowdown in hiring? That's the forecast. Do we see unemployment go up? That's not forecast at the moment. And the question then becomes, how much does this matter? Because we get a couple more payroll reports and CPI and PCE reports before the Fed will next meet in September.
Before we get to September, Mike, might have some dissent on Wednesday. Can we just talk about that dissent? How much dissent do you actually think we'll get?
I suspect that Chris Waller is going to have to dissent. He's put himself in a position to do that. He could make the argument that if we get GDP or PCE numbers that suggest that things aren't all that bad, that he's okay with holding, but he wants to cut in September. Mickey Bowman's a more interesting question because she had said if the economy develops in certain ways, we could see a cut in July. She didn't promise or advocate it as much as the Governor Waller did. So we'll see, and then it's going to be a question of whether the market thinks it's important or not, or it's been telegraphed so much that it just gets lost in the noise about September.
Mike McKee, thank you, sir. Looking forward to the Fed decision on Wednesday, payrolls on Friday. Steve Ricchiuto of Mizuho with a bullish forecast for Friday's payrolls report, calling for 140,000 jobs to be added and expecting the unemployment rate to tick up slightly. Steve joins us now for more. Steve, good morning.
Good morning.
Sign of the times that maybe 140 is called bullish now for the labour market. What's changed?
Well, you are further into a business cycle. You do have a labor market shortage. You do have a very, very tight labor market. So it's hard to continue to add large scales without causing a certain amount of disruptions and a dramatic rise in wages. And I think companies have been resistant on that. I also think there's a bit of a technology shift taking place. I don't think it's all the AI, but I think it's further adopting of the traditional types of technology that we need to do things in the service industry with more and more kiosks popping up everywhere. And I think that helps the situation as well. So we're supplementing labor or get a little bit with capital where we can.
You have some people like Chris Waller, governor, who's expected to dissent, the first dissent on the Federal Reserve since 1993, potentially on Wednesday, coming out and saying he's seeing cracks. He's seeing signs that there is instability in the labor market. Do you reject that wholesale, or do you just say that that is something that comes along with the changes in technology and demographics?
Well, I do reject it wholesale because what we see in terms of the claims numbers, what we see in terms of the continuing claims numbers, leave us in an environment in which, there's a healthy labor market environment. We see no evidence whatsoever in the data that's less likely to be disrupted by any kind of flow differentials. We also see it in terms of the JOLTS numbers, which I don't particularly like, but the Fed seems to like, in terms of hiring, quits going back up, in terms of hirings being healthy, in terms of job openings going back up. So I don't see where there really are cracks in the labor market. It's a traditional a slowing that takes place as you get this far into an environment and, oh, by the way, adjust it for how tight the labor market fundamentally is.
Given the fact that we do see some sort of slowing, at the very least, is there anything inflationary about this labor market? Is there anything about wage growth that would give you confidence that we could see more than just a one-time price adjustment from tariffs?
Oh, I think you're going towards a 3% inflation rate, and that's part of the issue. I think it's from a labor market tight standpoint. I don't necessarily have to talk about tariffs to tell you I think we're going to 3% inflation. And I question whether or not tariffs themselves will be reflected in prices substantially, because you look at, importer margins, they're very, very wide. You look at exporter margins with the dollar going down, you've got that benefit coming through. The little bit of goods prices we've seen, given the fact that the dollar has depreciated 6 or 7% in the last year, not surprising you see a little upward movement in prices that would typically just take place from the currency standpoint. And actually, it's not even keeping pace with the currency standpoint because global deflation is real. And that's the other thing that's offsetting and helping the exporter margins widen, because as China dumps all its goods everywhere else in the world, these people are sitting there with their raw material base starting to get cheaper, and therefore they could absorb the margins more. And China is dumping goods everywhere that they can't dump here anymore.
Overcapacity is a massive issue, particularly for the Europeans, that's for sure. You said something really interesting that we need to unpack. The labour market might be a reason to be hawkish still. Governor Waller was in your seat a week, 2 weeks ago, and made the case that the labour market is increasingly becoming a reason to be dovish. So I just want to give you some time. What's happening in the labour market right now that you think is going to keep them on the back foot?
I think the fact that the unemployment rate is not going to go higher. I think the movement to 4.2, we've been there and they've done nothing. But I think when you look at the fundamentals of the labor market and what will drive that unemployment rate up a little bit, you're going to discover that it's positive signs. An expansion in the labor force from not having expanded for 2 months in a row. That's going to be the kind of thing that, gives you an environment where, and that's probably going to wind up in a little bit increase in unemployment temporarily. You're going to wind up in an environment where it's a healthy expansion in the labor market, healthy upward adjustment in the unemployment rate. I don't think there's cracks in the system. When I look at the earnings numbers, my earnings revision tracker is now positive after being negative for weeks on end. It's now been positive for 3 weeks in a row. Companies are revising up earnings. We're at 10.9% for this year, 13.9% for next year. These are solid earnings numbers. These aren't kind of an earning number where people sit back and say, I have to scale back on employment dramatically. And I think a lot of the announcements that you're picking up on in the labor market are taking place in states where you're required to announce the layoffs, but you're not required to announce the net hirings. And I think that becomes part of the problem. It's selective decision to look at the information. And this is a confirmation bias I think comes from the dots. If I were to drop Jonathan Ferro out of an alien spacecraft, you had been studying the Federal Reserve for years, you'd been studying the U.S. economy for years, but you didn't know anything about the dots, and I dropped you in Arizona right now, okay, you would come out of that spacecraft and you would be like, oh, the Fed shouldn't be cutting rates. But everyone else says the Fed's cutting rates. Why? Because the dots are there. So everyone's biased by the dots.
Other people might cherry pick some labour market data right now. Lisa's talked about a few things. Entry-level hiring, not great at all. Job switchers, not getting that boost to pay. You talked about the labour market and the tightness there. Sufficiently tight to generate stronger payrolls growth, stronger wage growth that keeps this Fed reluctant to cut interest rates?
We've got an hourly earnings number of 0.4%. That's, again, consistent with a 4% rise. A 4% rise is consistent with 3% inflation. Fed's target's 2. We're at 2.7, our estimate for the upcoming PCE deflator. They're 0.7 off the mark, 0.3 closer to my number, 0.7 away from their number. I'm sorry, I think they're not in the position to cut rates. And if they were to cut rates, I think it would be a mistake. And I think you'd discover exactly what happened last year when they cut rates, and that is the long end of the curve would sell off. So it would be a bear steepener.
Which at a certain point is the reason why people are also looking to the auctions. Sorry, I had to say that. I've been remiss. There are auctions today and tomorrow, 2-year, 5-year, and 7-year notes, but also the Treasury refunding announcement that comes on Wednesday, when maybe we get a sense of whether any of this will matter for the U.S. government's debt financing costs, because maybe they'll issue everything in T-bills and just retire all of their coupon, all of their Treasury bonds. I mean, how much are you looking at that to really understand exactly how this Treasury Department is going to manage this and whether it's going to have any market ramifications?
Well, I think there's lots of reasons to expect bill issue sizes will go up. Back when I began, which was ancient history in terms of the market, one of the things I had to do was estimate the Treasury's operating cash balance. So I had to figure out financing and how to figure out the net cash flows. And we assumed every single quarter, a third of all the net new money would be raised in bills. That's not happening now. So yeah, there's more bill issuance coming relative to coupon issuance.
When you came in, you said that there's something else that you're looking for.
Well, stablecoin is something that I'm going to be looking to see whether or not Treasury Secretary Bessent, if he's back from his overseas trip, and talks further about stablecoin than he did at the May refunding announcement. You know, he made a statement at that point in time that I think is stuck in a lot of people's minds, and I've visited a lot of accounts. And some of these accounts are very, very interested in the whole stablecoin concept. And where do we go with stablecoin, and how much of it will be financed through bills? And he talked about $2 trillion market cap. You look at stablecoin now, it's about $300 billion. So that's telling you there's a long way to go. And I question whether or not, if you wind up with it being done properly, if you wind up, for example, the Federal Reserve issuing its own stablecoin, could you then be in a situation where we might actually replace a lot of our electronic transfers of wires and replace the SWIFT system with something more simple and less costly for the end result user? And I know the banks don't want this because clearly it influences a business they make a lot of money on. But clearly the end user wants it. I can imagine a place like Walmart, Target, Boeing, these big people, these exporters, these importers, all sitting there saying, you know, this would be great. It reduces my costs. I really think we have to do this. Right now, we've got lots of stable coins going in different directions and trying to do different things. If we could find one way of unifying it and putting them all on one network, or creating it all in terms of one large ability to do it, for example, with a Treasury coin hosted on a Federal Reserve website, I think you could get a very fast adoption of the technology.
Do you think it leads to increased T-bill demand?
I do think it leads to increased T-bill demand because I do not believe it'll affect currency in circulation, which affects the rest of the Federal Reserve's portfolio. Currency in circulation as a percentage of the economy, as a percentage of financial transactions, is not going down. Yes, a lot of the currency in circulation is outside the country, but we still have the currency that's in circulation winds up outside the country. But we do have, as a result of that, the big Federal Reserve portfolio, and I don't think it changes. So yes, what happens in terms of stablecoin, I think will be a net new demand.
Interesting. Happy to catch up with you this morning.
Cheers.
A lot of the audience writing in as well. Steve Ricchiuto of Mizuho having a tremendous year so far, dead on so far this year on a lot of issues.
He's never got caught up in this sort of recessionary call.
The crazy stuff?
No.
Didn't sound so crazy back in April.
Listen, he did sound crazy in April, sorry. But he was right. And this is something that a lot of people are looking to. The stablecoin issue, we got to get more into that. We got to get someone on to really go deep dive into this. Well, yeah, but let's keep going with this.
Okay, we'll keep trying. Mike McKee writes in, thinks I was dropped out of a spacecraft. So, Michael, thanks for that. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. Samsung Electronics will produce AI semiconductors for Tesla. Sources telling us here at Bloomberg the deal worth $16.5 billion will run through the end of 2033. Musk confirming it on X, saying the $16.5 billion number is just the bare minimum and that actual output is likely to be higher. The win for Samsung comes as it moves to regain ground in chip manufacturing. Meanwhile, Mark Zuckerberg is escalating his AI hiring spree. The Meta CEO announcing on Threads the company hired ChatGPT co-creator Shenzhen Chao as chief scientist of its super intelligence labs. Chao will set the research agenda and scientific direction for the new lab, which focuses on foundational model and next-gen research. And Boeing is preparing for factory workers to strike at its St. Louis defense hub after they rejected a contract offer. The International Association of Machinists and Aerospace Workers said its members overwhelmingly voted against the new terms that would have boosted their wages by 20%. The union represents 3,200 Boeing defense workers. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next on the programme, we'll set you up for a big week ahead. Plus, we'll catch up with Troy Gayeski of FS Investments following 5 straight days of equity gains, and we're looking to make it day 6.
We're looking at deals with 3 or 4 other countries. But for the most part, I can't get them to understand that it's the letter. We just sent that letter, and that letter is, very universal for most. They'll probably receive a letter of clarification or a confirmation type letter, which will go out sometime during this week, prior to August 1st.
The president's trade deadline coming up on Friday, August 1st. What a week. coming up as we count you down to the opening bell. This is your week ahead, your trading diary. Later on today, US-China trade talks underway in Sweden. Look out for the outcome from that. We're all expecting a 60-day extension or a 90-day extension for these talks. Coming up tomorrow, earnings from Starbucks. Wednesday, a Fed rate decision and Fed Chair Jay Powell news conference, plus earnings from Meta and Microsoft. Thursday, another round of jobless claims and results from Apple and Amazon. Friday, payrolls Friday, just around the corner.
Yeah, at a time when a lot of people think that this is a solid labor market, but some people, particularly on the Federal Reserve, are starting to see cracks, and that might be the justification to cut rates as soon as July, or at least those among the dissenting members may believe so.
Steve Ricchiuto pushing back.
Pretty hardcore, saying absolutely there's no reason to, and watch out for the long end to really rip in terms of yields going higher.
How many banks have we got now saying no rate cuts in 2025?
Well, there's Bank of America, I think
Stanley,
that Morgan Stanley has come out, Ricchiuto's come out. There have been a number of people who have come out and said, look, there's no reason. Ed Al-Hussainy is saying the same thing. There aren't really signs of it if you look at the firming up of the data and the surprise index turning positive over the past couple of weeks.
Let's keep it on the market right here on Bloomberg. Troy Gayeski of Future Standard writing this. The biggest issue for equities now that we have round-tripped on valuations is materially less upside. But if anything goes wrong, materially more downside. Troy joins us now for more. Troy, welcome to the program. The capacity to absorb bad news in the year ahead, do you think that's diminished over the past few months?
Yeah, it's certainly diminished greatly since, the several weeks after the Liberation Day plunge, because a lot of the technical strength that came in, first came from large multi-strategy hedge funds releveraging, and then it came from systematic trend followers. And then last but partially least, per se, would be the risk parity managers that as volatility drops, they can lever up their balance sheet and take more length. So, at this point, it's really all on retail dollars to continue to flow in to drive multiples higher. The point was just that compared to 2, 4, 6 weeks ago or even 2 years ago, you just have a lot less technical strength to drive even further multiple expansion. And we are materially more expensive today, not only in the S&P, but also in small and mid cap than we were in 21. And at the time, the Fed was obviously pumping in a tremendous amount of liquidity, and we had massive fiscal stimulus and an economic rebound.
At this point, though, Troy, a lot of people are saying that multiple expansion makes sense given the technological advancement that will increase profitability and efficiency at a number of big U.S. companies. Why is that not enough for you?
Oh, well, look, I've been a big proponent for the last several years, if not longer, that the combination of having the greatest 5 companies in the world listed in the U.S., higher profit margins, tremendous free cash flow margins, combined with a very important technical of reduced supply of equities, which is pretty consistent in terms of 40 to 150 basis points of equity supply comes out. And we still have 4.6% more money supply relative to nominal GDP than we did prior to the pandemic, should drive multiples slightly higher over time. So we're basically 23.6. I think by the end of next year, end of 27, we'll be roughly 25 in the S&P. But that being said, it's just, when you're looking at a relative basis, do you want to put additional money to work at these rich valuations? When you have other options like private credit or middle market private equity, where you're getting NASDAQ-like revenue growth with much cheaper valuations. So it's a time, just like in alternatives, in capital markets, to be a bit more differentiating in terms of what additional capital you're going to put to work at this particular juncture in market and economic history.
Troy, this is something a lot of people have said when they've come on. They've said, if you want to diversify, bonds aren't going to cut it in the same kind of way. The dollar clearly isn't going to cut it. Gold is already pretty highly valued, so people go into alternatives. What makes you think that the past couple of years aren't a sort of a sign of what's to come, given the fact that we've seen real outperformance of public markets, actually, to a number of private markets, private equity in particular, and it's gotten pretty crowded in that space, too?
Yeah, well, I think, again, there's nothing wrong with having a healthy allocation to U.S. large and mega cap, right? We have tremendous fundamentals. Valuations are stretched. The question from an asset allocation standpoint is, what do you complement that with? Again, do you chase U.S. small cap at 28 times forward earnings based on 20% forward earnings growth, which I don't know any analyst that thinks that's really going to transpire? Do you instead chase a currency trade that drove really short-term outperformance of European assets, for instance, or international? Or do you focus on assets where you do have a tremendous growth, NASDAQ-like revenue growth as NASDAQ revenues come down, at much more reasonable valuations, approximately 35 to 40% below where the Russell 2000 trades on an EV to EBITDA basis. So that's the fundamental question, right? Now, to your point, look, a lot of the drawdown vehicles have struggled because multiples have come in substantially, and it's been hard to exit. However, the evergreen vehicles, which have been leading mainly into secondaries and co-invest, have performed very consistently, including 22, which was the last doozy of a bear market, and also hung in there rather well during Liberation Day. Because when you're starting at very low valuations and you have great growth, you have tremendous convexity, meaning you have less downside if things go wrong and more upside if the economy continues to expand.
Hey, Troy, appreciate the update. Troy Gayeski there of Future Standard. Just getting some live pictures now that I wanted to send you over to Scotland with, over in Turnberry, the President of the United States alongside the British Prime Minister, Sir Keir Starmer, opening up that conversation on Gaza.
Yeah, real concern there about famine in the region. And they're talking about that, as well as the trade agreement that they came out with Trump saying that their relationship is unparalleled. What we hear about from Starmer is saying people in Britain are revolted by what they're seeing over in Gaza. So clearly something very concerning for him and for a lot of people.
They're certainly not alone. As we track that, we'll bring you the headlines as we get them right here on Bloomberg TV. Just want to set you up for tomorrow. What a lineup. Peter Chi of Academy Securities, Michael Wilson of Morgan Stanley leaning into his bullish case for the rest of the year over the next 12 months. Stephen Stanley of Santander is looking for zero on payrolls on Friday. And the new biggest bull on Wall Street, John Stolfus of Oppenheimer, looking for 7,100 on the S&P by year end.
One of the big surprises has been the upside revisions for a lot of companies and the upside projections for what's to come. How much is that behind suddenly all of the revisions upward by a number of stock bulls across the street?
What a year this has been. Hey, July 28th.
What a decade. Come on.
In the space of what? 2 months?
Exactly.
Feels like 2 decades.
I mean, well, we've gone around the trip and around the world in about in about a couple of weeks. So there you go.
Phenomenal. Live from New York City this morning. Good morning to you all. Thank you very much for choosing Bloomberg TV. This was Bloomberg Surveillance.